market remains dependent on tech.
The CapEx figure is what you got to be laser focused on.
We're just really not seeing the rest of the market able to overtake that Mag 7 cohort.
Tech breadth is broadening across the sector.
The technology genie comes out of the bottle. It never goes back in.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, preparing for a big one. Fed Chair Jay Powell gearing up for what could be his last meeting as the White House reportedly prepares for an extended blockade of Iran. 4 of the biggest companies on the planet reporting quarterly earnings. Meta, Microsoft, Amazon, and Alphabet.
That, to me, is the most important aspect of today, to understand whether or not the rally that we've seen so far, particularly in tech stocks, can continue despite all of the headwinds everywhere else. Do we get the results that justify $650 billion of CapEx spending this year? Do we see an acceleration of that spend into next year and beyond? And does the market digest that, given the fact that people are getting a little bit squirrely about some other aspects of the global economy?
This is the story that supported this equity market, and we need it to keep supporting this equity market because the other story is putting the squeeze on things. Crude up once again, potentially higher for what? 5, 6, 7, 8 consecutive days for Brent crude, up this morning by 3%, 115, and this from the Journal. President Trump instructing Gates to prepare for an extended blockade of Iran, according to U.S. officials.
Blockade until they cave. That is really the tone right now from the White House. And you go on to read the remaining of that report. What the Wall Street Journal is saying is that Trump assessed that his other options, resume bombing or walk away from the conflict, carried more risk than maintaining the blockade. So they're not escalating, but they're not de-escalating. And right now, when you have that blockade, and Kepler's talking about 12 to 22 days, that's when we can potentially see some shut-ins. And there are reports that the economy right now is struggling when it comes to Iran.
You can see this rippling through asset classes, so let's go through them. Start with crude, $4 away from the closing high on Brent, at the front end of the futures curve. That's crude, that's commodities. Check out bonds, retesting the highs of the year. For the long bond, we're right there on 30s. And then equities. Equities on its own planet, already up from the lows and nowhere near to retesting them, higher by more than 10% from the late March low.
There is one little sign that maybe things are not as complacent under the surface, and that's the equal weight S&P 500 that isn't making those new highs. And you are seeing it sag to some of the lowest levels that it's been. So you start seeing that versus big tech, and you can see this is a completely tech-driven story. This is not some sort of macroeconomic call on the U.S. economy accelerating, although it is if you take a look at some of the earnings, which is also what's been propping up some of these equities. This is a difficult moment. The earnings have to come through, or else that really does take the one pillar out of the market that's holding everything up.
The equal weight S&P 500 down for 6 consecutive days, the longest losing streak so far this year. Coming up this hour, we'll catch up with George Goncalves of MUFG as the president considers an extended blockade. Angelo Zino joins us of CFRA with big tech earnings on deck, and Priya Misra of JPMorgan looking ahead to the Federal Reserve. We begin this hour with stocks holding steady ahead of a critical day for Wall Street. George Goncalves of MUFG writing, it's one thing to climb the wall of worry, it's yet another to be in denial of the reality still to come. We think broader financial markets have overshot again and are at risk of serious disappointment. George joins us now for more. George, good morning.
Good morning. Good to be
That's
here.
a bearish way to start this morning, sir.
It's a bearish way to start. It's potentially Powell's last Fed day, and we'll see if he can change that kind of bearishness into some sort of optimism here. But I think it's the right call.
What do you think we're going to be disappointed by?
I think we're going to be disappointed by a number of things. One, if you go back in the analogs of history, and if you look at, again, people don't like to go back to two distinct periods, 2008 and 2000. People just don't like those 2 years. And you can have good news, and you can have markets end at a high note and then kind of top tick things. And so earnings really do have to deliver today. And you have a lot of optimism already priced in. You have valuations, again, back to screaming high levels. It's all about the equity market. It's all about the tech sector within the equity market. And one could argue that makes the economy much more fragile. Each time we do this, we are so dependent on stocks never going down.
Paul Tudor-Jones, legendary investor, speaking to Patrick O'Shaughnessy in a podcast and saying this: 2000 was the easiest bear market I've ever seen in my whole life. Went on to say it's got so many similarities to right now. What are the similarities to right now?
The similarities are a concentrated kind of view, the euphoria around a new technology like AI. The sort of kind of liquidity that created, meme stock and like investing. All of this is kind of very similar. We use different ways of expressing what was happening back then, But it was bubble-like conditions, and there's, I think, a repeat of that happening now.
You said something that I find really interesting, which is that this market going up is one of the big reasons why people keep being bullish. It's almost like a Ponzi scheme of bullishness, right? The market goes up, so you feel bullish, so you put your money in the market, and it goes up. How big of a pillar is that to the overall recovery, to the resilience in the U.S. economic data, to really underpin the justification to keep going into stocks that make them keep going up, that then keep propping up economic conditions?
Yeah, it is kind of a vicious kind of cycle up. The question, we haven't really felt the vicious cycle on the way down, largely because there's really no net sellers or real sellers, and most large investors have to be fully invested to kind of participate with the upside. And when they do try to hedge, they use the options market, which then creates these sort of squeezes on gamma, on options. So it creates this weird dynamic that's kind of perpetual until one day it's not. And we haven't felt that yet.
I guess the biggest counterpoint to that is potentially we've seen every single potential puncture point to that. I mean, well, you name it: high oil prices, high bond prices, uncertainty at the Federal Reserve, political uncertainty, hot wars. I mean, all sorts of concerns. Why hasn't any of that been enough?
I mean, look, I think the market structure has clearly changed. I mean, there's been well documented the passive flow. That's why I've always looked at the jobs market as the most critical component. People have jobs, they contribute to their 401ks. It keeps the system going, right? I think that's why it's so critical that we're at this interesting inflection point, potentially, that if AI is really that good, it's going to hurt the jobs market over time, at least in the short term, I think it will, short to medium term. And as you retool the economy around that, you might lose, like AI is not going to be contributing to 401ks. They're going to be replacing, like you start like doing windfall taxes at corporations. This is a really interesting crossroads. And maybe just the totality of all these things will start to be like a burden on the economy. At some point, it's that last straw that breaks the camel's back.
Aren't we already doing some of that when the president comes out and says tech companies need to basically subsidize consumers' energy bills?
Look, I mean, I think there's going to be a need for kind of cost sharing, load sharing for sure in the future.
And you think it's going to be more of a burden on corporate America to pick that up?
Look, ultimately, how this all shapes out, I really don't know. No one knows the future on how this works out. It's going to depend on future administrations more so than anything else. But I feel pretty confident both in this election cycle and in 2028, AI is going to be on the ballot box.
What do you think it is this year, before we get to 28, that shakes this market out of what you believe is denial?
I think, the front and center is the oil price. And I think just the fact that we've been into denial, the biggest denial is that somehow we can turn on and get production back, that we can kind of replace all this inventory that's been depleted. And as we're going through that process, I think it's going to really be a kind of rude awakening for markets, that it's going to be a drag on growth in the second half.
We speak to Stuart Kaiser of Citi. This is something he's been talking about coming into this week, that these slow-moving risks just keep on building, and then you break. You reach a tipping point. I have no idea if we're close to one of those, but some people think we are.
And what people are watching is that long-dated oil contract and the fact that it's reaching almost $90 on Brent crude for December. People are watching that and saying, hold on, it's going to cross some bogey where suddenly the stock market's going to wake up and say, we're broken. We don't think we like this very much. And right now, you aren't seeing that. And part of it is because the earnings keep giving that forward look that is more positive. And at what point do you start to have to see some of this reflected in some of the rhetoric coming from the C-suite?
George, are yields higher now for different reasons, or the same reasons we made those highs just a month or so ago?
I think yields are higher for a number of different reasons, and they've not participated in the broader risk rally because it is a pure macro kind of expression. And so it is capturing a longer kind of wait and see mode for central banks, not just in the U.S., because the hawkish rhetoric that's been coming out from overseas has also kind of pushed up U.S. rates. The global kind of rate connection is there, and it's clearly an issue for the U.S. bond market. And fiscal concerns, because we all know at some point if something does break, the government's going to come to the rescue. So I think there's a lot of different factors that are kind of at play.
But to John's point, earlier in the conflict, people were looking at higher yields as a result of rate hikes in direct response to oil prices, which was absolutely a negative. Yep. Now suddenly it's because the economy is doing just fine, the consumer can keep spending. It's almost like yields are rising for the right reason. At what point, even if they're rising for the right reasons, does it become a breaking point for equity valuations?
I think markets get enamored around clear lines in the sand. 5% on the 30-year, if that breaks. You get above 450 on the 10-year. And if you were to ever go back to 4% on the 2-year Treasury, then the market, I think the broader markets like stocks would actually care about that.
What business does the 2-year have at 4%? So we asked that question repeatedly back in March. I think we have to ask it once again at 385. What business does the 2-year have at 4% when we, as far as we understand, the bar to hike at the Federal Reserve is incredibly high? What business does a 2-year yield have trading above Fed funds?
I really think it has very little business. So we're actually relatively constructive at the front end. We think that's the best sweet spot, highest risk reward for the bond market is being long positive carry treasuries in the front end.
So right now, looking forward, what's the best hedge to something potentially breaking, although it hasn't yet and could potentially keep going?
So unfortunately, it's been the trade that's been the hardest to kind of keep in place, which has been the curve steepener. And that's the best macro expression that has to get reset every so often because it doesn't deliver until it does.
George, it's good to see you. Thanks for breaking it down. A bearish start to this Wednesday morning, going into a massive slate of earnings after the closing bell and the Federal Reserve decision later this afternoon. 30s at 495, 10s at 436. With an update on stories worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Trump telling his staff to prepare for an extended U.S. naval blockade of the Strait of Hormuz. The Wall Street Journal reporting the president has decided the blockade is a less risky option than resuming bombing or extracting the U.S. from the conflict entirely. The White House is working on dialing down its feud with AI giant Anthropic. Axios reporting the U.S. is developing new guidance that would allow agencies to get around Anthropic's supply chain risk status and begin onboarding its new model, Mythos. A draft of an executive action is reportedly in the works. UBS posting first quarter earnings that beat analyst estimates. The investment bank increasing revenue by almost 30%, with equities and FX delivering the biggest boost. UBS is giving cautious signals of increasing the $3 billion buyback it's already lined up amid ongoing tension over Swiss regulation. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour. Up next on the programme, standing firm against Iran.
We're doing a little Middle East work right now. We have militarily defeated that particular opponent, and we're never going to let that opponent we're never going to let that opponent have a nuclear weapon.
Up next, we'll catch up with Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning. Check out this day ahead. Just look at it. 2 p.m. Eastern Time, Federal Reserve decision, 2:30 news conference after the closing bell. Microsoft, Amazon, Meta, Alphabet, just phenomenal. The earnings slate later on this afternoon. And this morning, the small matter of a vote to look to push forward the confirmation of Kevin Walsh for the top of the Federal Reserve.
Finally, the Senate Banking Committee will have that vote. Senator Tillis is going to vote yes, so it's going to get out of the committee. Not only that, he might pick up 2 Democratic votes in that committee, which would be a pretty big deal for Kevin Walsh.
I'd like to make a proposal. I think they should spread this out. I don't think that this is good casting. I think that they really need to, a little bit every single day so we can adequately focus on it all, because this is just a bit too much.
You're trying to produce.
That's a day ahead.
I think we need to produce this particular news
It's
cycle.
a day ahead that gets you out of bed. That's what it is.
It's my favourite week. If you love financial markets, this is the week for you, without a doubt.
That's right. So spread the joy. Make it a little bit so you can really
make it your favorite month.
Some drip feed of
exactly.
Tech earnings on
Microsoft.
Thursday and Friday too.
Yeah,
okay.
I think that's all I'm saying. I'm not saying to take away from the week. I'm
you
saying
want to build up.
To build. You need the drama, the crescendo.
But how good is it to have a Kevin Walsh Senate Banking Committee vote right before we hear from Jay Powell?
It's perfect scheduling.
Yeah.
You happy with that scheduling?
That's good.
Sure. Okay.
Well done, Washington.
All right. Washington delivered for once.
Exactly.
All right. Good to see. Equity futures right now in the S&P 500 just about unchanged. So the Nasdaq elevated, bouncing back by 0.3%. Notable the moves elsewhere, particularly in crude, in commodities and in the bond market too. Check out crude. Looking at another day of gains for Brent. Brent crude up once again by, what are we up by, 3% this morning? 8 days of gains for Brent crude, up 3% to about 115 and just short of the closing high. Since this war started, and that closing high had a 118 handle.
This is really the Stuart Kaiser point that we keep going back to. What's the tipping point here when markets wake up and say, this is no longer something that's temporary? It isn't temporary when it's 2 months, 3 months, and we potentially have no end to it. And when you don't have a sense of how quickly some of these barrels can get back into the market.
Folding that move in crude into the bond market too, Bramo. Just starting to see yields drift higher once again. It's a stealthy sell-off with 30s back to 495, 10s at about 436, and yields up again at the front end of the curve by 2 to 386.
There's some discussion about the Federal Reserve this afternoon signaling that they aren't necessarily interested in multiple rate cuts going forward, that maybe they will adjust policy downward. There's also a push to potentially put in that symmetric risk of potentially a rate hike. How much will that matter to markets? Will it make people feel like maybe the 2-year has business doing somewhere around 4%? Or does it sort of get dismissed as, well, it's just Fed Chair Jay Powell trying to leave his last mark?
Trying to anchor inflation expectations.
Yeah.
There's just a sense that even if they have that more symmetrical bias, you drop the easing bias, that no one's really going to believe it. Are they really going to hike interest rates? One bank thinks they might. BNP Paribas. James Egelhoff making the case that maybe the next move is a hike, potentially, not the base case, but at least exploring the potential for that later this year.
I would like to see the conversations between President Trump and Kevin Warsh, if that were to happen. I think that would be interesting. Let's see.
Let's talk about the commodity market. Under surveillance this morning, standing firm against Iran.
We're doing a little Middle East work right now, too, if you might know, and we're doing very well. We have militarily defeated that particular opponent, and we're never going to let that opponent we're never going to let that opponent have a nuclear weapon. They know that, and they've known it right now very powerfully.
Here's the latest this morning. President Trump reportedly telling aides to prepare for an extended blockade of Iran to force the country back to the negotiating table. Some great reporting once again from the Wall Street Journal. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, as talks remain stalled, we've actually already heard from President Trump today with a 4 a.m. Eastern post saying that Iran, quote, better get smart soon. That seems to be adding to the sense that the U.S. isn't too interested in the off-ramp that Iran presented that could see a reopening of the Strait of Hormuz in exchange for the U.S. lifting its naval blockade. But that proposal would delay or postpone any dialogue around Iran's nuclear program, something that this White House maintains just is not acceptable. And that's led the Wall Street Journal to report that in recent meetings, President Trump has opted towards keep squeezing Iran's economy and oil exports by keeping this blockade in place, deeming it less risky than, say, resuming fighting or leaving without any potential deal. And the proof is already there that this is the course of action that the U.S. is sticking to, as CENTCOM yesterday confirmed that it had boarded another commercial vessel in the Arabian Sea under suspicion that it was headed towards Iranian ports. And we saw this doubling down by the U.S. Treasury Secretary Scott Bessent in a post on X yesterday, saying that the U.S. will continue its, quote, maximum pressure campaign when it comes to the Iranian economy, and that he claims that Karg Island storage capacity is nearing its highest level. Now, John, in addition to this, we also saw Bessent's Treasury Department yesterday issue a warning to financial institutions against facilitating transactions with Chinese oil refiners with ties to Iran, as Beijing still remains that #1 consumer of blacklisted Iranian crude.
Tyler Kendall with the latest from the nation's capital. Tyler, thank you. For market participants out there reading that story from the Journal, I'm sure it went something like this. Extend the blockade. An extended blockade. What was this? Haven't we already had one for the last 2 months?
Well, exactly. What do we mean when we talk about extended? It's extended beyond what? 1 month, 2 more months? And that difference is actually really important.
Joining us now to discuss is Colonel Wayne Sanders, Senior Defense Research Analyst at Bloomberg Intelligence. Colonel, welcome back to the program. Just working through the Journal piece, Tyler went through some of this. There seems to be 3 options on the president's desk: maintain a blockade, resume the bombing, or walk away. Do you see one choice is more likely than the other at this point?
Yeah, I think that extending the blockade right now is definitely the best option that President Trump has, because the blockade is working. It's providing the pressure that you're already looking for. The bombing campaign did a great job of destroying a lot of the military infrastructure across Iran. But at this point in time, Iran has already proven they're not exactly worried about the Iranian people, and some additional military strikes I don't think is really going to gain the U.S. anything. It actually makes the U.S. look more like an aggressor on that if we were to continue to do that without being provoked by Iran. Iran, since April 13th, has pretty much stopped their drone strikes as well as their missile strikes, and has really focused all their effort into the Straits. So I think at this point in time, when you look at the leverage of national power, right, you have diplomatic, information, military, and economic. At this point in time, I think the economic lever right now in the Strait of Hormuz is probably the biggest one that President Trump's using.
Well, and they're doubling down at Treasury, at least. They're talking about how putting out a statement to financial individuals to not participate in the toll, And then on top of that, when it comes to OFAC, they're basically making it a lot harder for those Chinese teapot refineries to accept Iranian crude. Do you see any evidence that this is actually moving Iranians on the ground in the regime to want to come to the table when it comes to the peace talks?
The only reason I would say that it does is because they have not moved on back to military operations. I think if they were at that point in time not worried about it, then they would just go back to hitting the strikes. But I think the fact that right now Iran is still staying low on the strikes and is focused more on this, they're still doing it in the shadows. They're still moving around in the background, trying to find a way around this. They've looked at trying to figure ship to ship, in terms of moving some of the oil around and all that. But the blockade is in place. U.S. CENTCOM has already reported, 34 to 37 ships have been turned around at this point in time. And the fact that the U.S. naval blockade is still actually boarding and interdicting some of these ships as well shows at that point in time to Iran that, hey, look, we're not going away. And I think President Trump's message to, continue to extend that blockade is very poignant and is the reason why he did it.
So how long do you think the blockade will actually be extended? Are we talking weeks or months?
Well, I think at this point in time, they're just waiting for Iran to break. I think at this point in time, U.S. CENTCOM and Fifth Fleet have the ability to keep this blockade in place. Military Sea Lift Command, Rear Admiral Nicholson had brought up a few days ago that, they figured it out now in terms of being able to provide the supply chains all the way for all three of these aircraft carriers in the carrier strike groups that are there. It's actually allowing them the opportunity to figure out how to supply the suppliers. He went through a whole big diatribe on that, which was great. Being able to show that, hey, we have the method and means necessary to be able to provide beans, bullets, fuel, and everything that is necessary to continue that blockade.
Colonel, it seems like the U.S. is being pretty clear about what they're doing as this blockade does go on. There's also discussion about how the military assets are positioned in the region. What's Iran doing with this time that does seem to be a ceasefire? Are they building up their drone capacity? Are they building back up or accelerating production of nuclear weapons?
I think at this point in time, the biggest thing that Iran is doing is they are trying to position themselves in case it goes back to a military strike type of war conflict that we had, prior to the ceasefire being in place. So a lot of it is going to be positioning those weapon systems. It's going to be trying to move the launchers around. They have to do it stealthily, obviously, because of intelligence, surveillance, and reconnaissance capacity of the United States. So they're doing a lot of that. The production capacity, if they have any of these additional production facilities to build the Shahed 136 drones, which have been very effective against the Gulf states especially, then they will continue to do that. But one of the biggest targets of this has been their drone production facilities. So I think at this point in time, it's the drones that they currently have. Are they positioned in the right place to be able to provide a strike? The IRGC fast boats continue to be a piece to maneuver them around the Straits of Hormuz in case there was going to be military escorts of additional vessels and they needed to be able to create a strike. They're doing the same thing that the U.S. is doing, and that is positioning themselves in the best way. They're doing something in wargaming that's called action, reaction, and counteraction. So they're putting all their things in the ground and saying, if the U.S. does this, we need to be prepared to do this. And then the U.S. is doing the same thing.
Colonel, you're one of the best, and we appreciate your time. Thank you, sir. Colonel Wayne Sanders there of Bloomberg Intelligence. We got a pretty healthy dose of hopium yesterday morning with two notes, one from the president, another from CNN. The president saying Iran had informed us that they are in a state of collapse and they want us to open the Strait of Hormuz as soon as possible as they try to figure out their leadership situation. CNN said Iran is expected to submit a revised peace proposal. What was notable about that is not whether I believe any of that is likely or not. It's how the market responded to it, or rather did not respond to it. That did not bring down crude over a sustained period of time throughout yesterday's session.
It barely registered in terms of the main stories that the market was looking at. They were watching the discussion around OpenAI. People have moved on because it's sort of, again, fool me once, shame on you. Fool me twice, shame on me. People are getting inured to headline roulette that doesn't pan out to anything.
Crude just grinding higher. And once again this morning, higher by close to 3%, close to 115 on Brent. Up next, we'll talk about tech. Angelo Zino of CFRA with Mag 7 earnings on deck. Plus, Yahira's got your morning movers. Starbucks rising on better than expected results. That stock is up by close to 5% in the pre-market. Live from New York City, you're watching Bloomberg TV. Stocks bouncing back by 0.1% on the S&P 500 following the biggest one-day decline in about a week. No real drama there at the S&P 500 at the headline index level. Away from that, though, the equal weight, as noted by Bramo a little bit earlier on this morning, 6 days of losses for the equal weight, the longest since November. So there is a bit of tension out there in the equity market if you look for it. On the Nasdaq this morning, up 0.4%, going into a stellar slate of earnings later on this afternoon after the closing bell. Want to turn to crude. 8 days of gains for Brent. Over that period, higher by 27%. The longest daily winning streak going back to May 2022 and just short of the high of the year, just short by some $4 this morning.
And this raises two questions. Number one, why is the U.S. shrugging it off? And number two, how much is this really going to pressure Europe at a disproportionate pace? This is really going to be the tale of the haves and the have-nots among companies, the have and the have-nots with industries and with regions. And that seems to be what's happening under the surface.
Goldman came out with a new forecast and we made a big deal of it. 90 on average for the fourth quarter. Sounds terrible. Then you get into the numbers. Look at the contract table for Brent crude this morning. October 92, November at 90, December at 88. That's an average of 90. Market's already there.
And this is why people are saying, where's the tipping point? If we're already there at some of these places, at what point will the market wake up to that? What you're seeing is a lot of diversification and ultimately people depending on the capex spending from big tech to support and offset any of the potential dampening from higher oil prices. Also, the momentum that we've seen in the U.S. economy really keeps it surprising.
And the blockade is continuing. And based off this reporting from the Wall Street Journal, it is not ending. The president doesn't want to escalate, but doesn't want to de-escalate. He's not willing to take a bad deal. So that means the blockade stays. And if you look at some of the imagery that's going on, we're seeing 30-year-old tankers that have been off the radar for years showing up next to Karg Island because the Iranians are trying to find any levers they can to start storing some of this crude.
Yields just creeping higher alongside that move in crude. It's notable. Retesting the highs of the year on 30s, very close on the long bond at 495. 494 this morning. Up at the front end as well, going into the Fed's meeting this afternoon. Up a single basis point, round it up to 385. Yields are higher now this morning than they were when the Fed last met at the close of business that day. I think that's interesting that yields have carried on creeping higher over that period.
And it's independent of any Fed action. This isn't necessarily some kind of commentary on Fed discussion. That said, the probability of a cut by December has gone down to 24%. That was 35% on Monday. So it's rapidly going down as people take a look at the balance of risks and some of the rhetoric coming out of administration officials.
Twos at 385. Let's get you some single names, some morning movers. Massive day ahead for Wall Street. Yahira has more. Hey, Yahira.
Hi, John. We start with Starbucks. Shares are rising nearly 5% in the pre-market as the U.S. consumer shows up in force, helping the coffee chain beat expectations and boost its outlook, even as China remains a weak spot. But CEO Brian Nichols saying overall, customers are visiting their revamped stores more, and when they're there, they are spending more on their drinks. Turning to the data storage company Seagate, shares are soaring nearly 18% in the pre-market on what the street is calling blowout results. The company beat on earnings and issued an outlook way ahead of expectations, all having to do with AI driving enormous need for data storage, and that is helping the company on both pricing and margins. And we end on Booking Holdings issuing a warning that the Middle East conflict is starting to weigh on travel demand, so shares are falling 5% in the pre-market. Its revenue guidance coming in well below expectations because the company says fewer travelers are booking trips and more cancellations. John.
It's one to watch. Yahira, thank you. Appreciate the update. More from Yahira throughout this morning. On our radar this morning, President Donald Trump telling aides to prepare for a prolonged naval blockade of the Strait of Hormuz. The Wall Street Journal reporting the president thinks the blockade carries less of a risk for the U.S. than resuming hostilities. Elsewhere, King Charles addressing a joint session of Congress urging the U.S. to maintain its leadership role in the world and in NATO.
I pray with all my heart that our alliance will continue to defend our shared values with our partners in Europe and the Commonwealth and across the world, and that we ignore the clarion calls to become ever more inward-looking.
At last night's state dinner, President Trump saying that King shares his position on preventing Iran from obtaining a nuclear weapon. And finally, UPS reporting first quarter earnings that topped estimates and signaled bigger buybacks this year. Santander's net income also beating, and Deutsche Bank reporting a record profit despite higher provisions for credit losses. That's the wrap for European bank earnings this morning.
Yeah, you did see some good earnings from UBS and possibly momentum, despite the fact that the currency it did seem to be dragging on a currency-adjusted basis with the dollar. Deutsche Bank was interesting. The credit provisions were for loan losses tied to commercial mortgage properties in the United States, particularly on the West Coast. And you start to see some of this come out, and it's just a mark to market that is bigger than expected in terms of the loss. These are the things I'm interested in. Where are people gaming out the weak spots that could potentially be problem areas going forward should the economy turn more significantly?
Guy Johnson sat down with Sergio Ramonti in a fantastic interview, and he was talking about how investors might be overconfident about what is going to be the outcome and the scarring basically from the Iran war, saying that the expectation is not only that things are going to be resolved, which he believes and hopes, but the impact of what happened will be resolved in a classical way. Basically saying we've gotten so used to basically things just going back to normal. And he's not quite sure things are just going to go back to normal after this.
Love Guy. Love Guy's work. Guy's the best. One of the best anyway. Don't want to offend all the other people.
Yeah,
but,
he was really pushing back on Ramonti in this
fantastic.
interview. It was a good interview.
Check it out with Sergio Ramonti and Guy Johnson on Bloomberg.com and on the Bloomberg terminal. Elsewhere, earnings from 4 of the Mag 7 due out after the closing bell. Angelo Zino of CFRA with a strong buy rating on Microsoft and Meta and a buy on Alphabet, writing companies have the ability to demonstrate faster than anticipated growth. Hyperscalers are likely to sustain, not increase, CapEx budgets. Angelo joins us now for more. Angelo, that last line's interesting. Are we entering a new phase for CapEx?
Yeah, so John, I don't know if we're entering a new phase, but I will say this, you know, we just saw these companies really kind of blow out their CapEx numbers back in when they reported Q4 results. So that was just 2 months ago, right? And when you kind of think, look ahead just 2 months later, I don't think much has changed. You look at where the street is at in terms of the CapEx numbers relative to where the guidance was. I think most, sell-side analysts are towards the high end of kind of the range that was provided from a lot of these hyperscalers. So when you just kind of look at, what these companies are at least going to do in Q1, I don't see any sort of major tick up in terms of CapEx budgets. That could change as we go into the second half of this year, and depending on what that trajectory looks like. But at least as far as Q1 is concerned, I wouldn't expect any sort of major change to CapEx budgets.
Angelo, we're all tracking that story from the Wall Street Journal this week, indicating that OpenAI was starting to struggle to meet its own sales targets. It raises some questions about their own spending commitments over the next year or so into 2030. How do you think the other big spenders would respond to a development like that one?
Yeah, I mean, I thought that was an interesting article, to be honest with you. That I thought there were a couple of interesting takeaways, but it was very vague in nature. But when I think about just OpenAI, I think that was somewhat, the writing was somewhat, writing was on the wall to an extent here over the last couple of weeks and months, just given some of the news flow that we had seen. But they had already reduced their CapEx budget from 1.3 trillion to 600 billion in terms of commitments. 600 billion still seems too high, but at the end of the day, I mean, listen, as long as the AI narrative remains intact, you continue to see strong adoption from the enterprise space. We'll see, actually, I think bookings growth in terms of the cloud guys reporting tonight is going to be really important, and what that non-AI OpenAI contribution looks like, especially for a company like Microsoft, which hinted towards 45% of OpenAI exposure last quarter. We kind of want to see what that non-OpenAI growth looks like, and I think it's going to be really strong, and I think these companies are going to be able to diversify away from OpenAI over the next couple of quarters. So I think that's a positive. But as far as OpenAI risk, inherently there's clearly going to be risk if they can't deliver and accelerate here, especially in ahead of a monster IPO later this year.
Angelo, you touched on something really interesting here, which is the rest of their business, other than just the AI-specific aspects. How important is that going to be, right? I mean, are we overly focused on the AI aspect, and are we really going to see more of a gut check on some of their core businesses from Meta Meta, it'll be the advertising and more cyclical aspects. For Amazon, it does sell clothes and things that you'd use to clean your home. And the others, just the wars over cloud computing.
Yeah, I mean, it's going to be key, right? The core businesses and really the two, big, most important trends is cloud growth, and it isn't all AI. And then, to your point, the digital ad market. And the digital ad market is going to be interesting to kind of see what, Meta and Alphabet say. I mean, you would expect the digital ad market to continue to be relatively healthy, but I think there are going to be pockets of weakness in areas like travel and what have you because of the war that's going on or the Middle East conflict at this point in time. So the guidance will be interesting. But as far as kind of the main driver here, it will continue to be AI. You look at Meta's expected growth here this quarter, 31%. Q2 expectation of about 25%. The digital ad market was only growing, about 10, 11%. So these, a company like Meta, well outpacing the industry largely because of that AI contribution and what they're delivering from an AI perspective to, the ad community.
Last earnings season, a lot of these big tech players were punished for accelerating their CapEx plans. You don't think we're going to see a repeat of that? There'll be more subdued CapEx spending plans if you call $650 billion for these four subdued. I'm just wondering how the market's going to take that. Is that going to be a positive, or is that going to be something viewed as maybe a lack of confidence or less confidence in the path ahead for AI?
Yeah, I mean, listen, I think as long as they sustain the CapEx spend, that's going to be what's going to be critical. I think everyone kind of realizes, hey, listen, these guys really, went out and just really ratcheted up the CapEx spend, probably more so than most had wanted them to do, 2 to 3 months ago. And I think that was a big reason you saw some uncertainty on the tech side of things earlier this year. I think that at this point in time, the street has kind of digested that. At this point in time, it's all about whether or not, you get the return on invested capital, whether or not you kind of get that accelerating growth and strong, bookings as we progress through the year. And that's really, I think, what the street is concentrated at this point in time. I think Microsoft will be a little bit interesting because they did report before both Alphabet and Amazon reported the last earnings season. And we all know that those two companies really, went nuts in terms of the CapEx spend. So I do expect Microsoft to potentially, ratchet up the commentary in terms of the CapEx spend this quarter. But again, I think that's somewhat discounted in the shares. You look at it trading about 21 times next year, the concerns on the SaaS apocalypse and what have you. So I think a lot of those concerns are baked into the stock.
Angelo, you mentioned the monster IPO that we're expecting for OpenAI, but are you concerned that it's been put on ice for this year?
Yeah, I mean, I think there's growing concerns of that, obviously, and we'll see how the year progresses. I mean, when you see some of the comments, in the journal and what their CFO Sarah Fryer has had alluded to. I mean, yeah, I mean, I think there's some concern about that. Again, we'll see how the year progresses. They did just do a massive raise in terms of the $122 billion. So even if the IPO gets delayed into 2027, I don't necessarily think it's going to have massive implications in terms of how they plan to spend. But yeah, I mean, I think the bigger risk is they need to see the growth accelerate as the year progresses. They need to be on the right track, because if they don't do that, I don't know how you possibly IPO, let's call it in Q4, and risk throwing that narrative out there to the street.
Things change a lot in this sector, and pretty quickly. I remember this time last year, Alphabet was dead, and look at that turnaround. Yeah. Angelo, thank you, sir. Angelo Zino there of CFRA. I'm pleased you mentioned the more cyclical parts of these companies, the likes of Meta, the ad business. That's something to watch for later. The cyclically exposed tech stories and how things are stacking up, given the war, given the increase on price pressure that we've seen as well around the world.
Yeah, there are regions that are putting off some of their spending plans because ultimately they've got other goals right now. Also, supply chain disruption. So you've got on one hand the cyclical aspects, and the other hand, are they having to pay that much more for chips and for other aspects to build out their data centers because of some of these supply chain fissures? These are all important aspects. It's one thing if you increase your CapEx plans. It's another that you're doing so because inflationary costs are making it so expensive that you got no other choice. Are those the same?
Nasdaq futures this morning, positive by 0.3%, a small bounce. Let's get you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Adidas shares rising in German trading. The company reporting first quarter results that beat estimates. Adidas seeing momentum in its apparel division and healthy demand for its football, running and training products. Elon Musk taking the stand in his case against OpenAI. Musk is suing Sam Altman's company because he says its pivot from a charity to a for-profit business is wrong. An attorney for OpenAI says Musk's lawsuit is an attempt to undermine a competitor to his own company, XAI. Former FBI Director James Comey indicted for a second time by the Trump administration. This time he's charged with threatening the president's life. Comey's lawyer says he vigorously denies the charges and will contest them in court. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in 30 minutes' time. Up next on the programme, calling for patience at the Fed.
The Fed has opened the conversation to not only holding policy steady, but potentially rate hikes. But the bar is extremely high. So more than anything, Powell is going to reiterate the need for patience.
Up next, the brilliant Priya Misra of JPMorgan from New York City. This is Bloomberg Surveillance. Massive day ahead of us. Going into it, the scores look like this. Equity futures up by 0.1%. Let's round it up. A few tenths of 1% higher on the Nasdaq and on the Russell this morning. In the bond market, yields creeping higher going into the Federal Reserve decision later. At the front end of the curve, twos up to 385. Under surveillance this morning, calling for patience at the Fed.
What we're going to hear from Powell is uncertainty, not only because of the international conflict, but the aged nature of the recovery, where we are on this pathway. The Fed has opened the conversation to not only holding policy steady, but potentially rate hikes. But the bar is extremely high. So more than anything, Powell is going to reiterate the need for patience to understand the evolution of the data and continue to remain in this steady pace of policy for now.
So here's the latest this morning. Investors looking for answers on how long the Federal Reserve will keep rates on hold at what's likely to be Jay Powell's final press conference as Fed chair. Priya Misra of JPMorgan writing, we can see the Fed cutting rates in the second half if core inflation slows down. Priya has more. Priya, good morning. It's good to see you.
Thanks for having me.
Let's get into it. Let's talk about what you're expecting in the news conference and in the statement later this afternoon.
Sure. So clearly no actual policy decision. What I'll be watching for is what's the, any sort of sense around this two-sided risk. It came up in the minutes. We don't think that that'll happen. I think Chair Powell has to keep talking about patience, wait and see. There's so much uncertainty. There's uncertainty on the inflation front. Do we get those second-order effects on core inflation? What happens to wages? There's also the labor market. So there's uncertainty on both ends. There's this AI once-in-a-generation, productivity increase. How does the Fed sort of navigate this? And I think he wants to come out of today, I think, with no market move. Because it's all about when does that straight open? What happens to the AI earnings? I think that's really, he wants to say nothing. I don't know if he's going to tell us whether he's going to stay on at the Fed. I hope he does. It's a risk management move, which he's brilliant for doing these risk management moves. But I think he just wants a boring wait and see, this is not our circus. That sort of an issue.
We'll spend some more time on his future in just a moment. I just have one final question on a more symmetrical reaction function. If they try and articulate that later this afternoon, would you believe them?
I think they are data dependent. But I think if they signal that a hike is as likely as a cut, I think the market's going to react. I don't think we're priced for that. We were maybe, 2 weeks ago, but now we've actually come back. I think the market realizes that the bar to hike is high. If they say it's equally likely, I think the market will react. I would look to fade it because here's the issue. Oil prices are high and those, forwards are starting to move up. There's a nonlinear impact at some point. It's very hard to argue at what level of these longer dated forwards. If oil prices stay high, that's a hit to consumer real disposable income. That's a hit to margins potentially with companies. I think it starts to wear on growth. But I think, so do they actually end up hiking? I think very unlikely if oil prices stay here or higher. But the market's absolutely going to react because I don't think we're positioned for a symmetric reaction function here.
The market's definitely going to react to any kind of commentary about whether Fed Chair Jay Powell is going to be governor still at the end of May or the end of December. Probably market has some odds on that. 35% chance that he'll be there until he will leave the board by May 30th and an 82% chance by December 31st. In the rates market, will there be a reaction reaction if he gives a signal one way or another?
So I don't think so. I think, we've been all debating this, and it's a little sad that we're debating that more than, when will the Strait open and what's the impact on the economy. I think the Fed is a democracy. He has one vote. So if he does leave, I don't think there's a big reaction. I do hope he stays. He's a credible, permanent voter. There's a lot of debate at the Fed around current policy as well as the framework, this regime change that Kevin Walsh wants. I think to have Chair Powell or Jay Powell stay on as governor, he's going to have a say in that matter. I don't think he's going to be shadow Fed chair. I think he's very careful. He will be very careful to let Kevin Walsh lead the Fed. But I think just having him there would be nice. It's a risk management exercise, as we're calling it. But I don't think if he says he's done, I think we should applaud him. He's the soft landing guy. He managed to cut rates, hike rates a lot, then cut rates, deal with two QTs. I think we would all be very grateful for the service to the Fed. But I don't think the institutional credibility is at stake if he decides to leave. Because you've got, many Fed officials, 18 other Fed officials, who are going to do the right thing for the economy. And I think I'm less worried about Fed independence, really unanchoring the long end.
This is the point that a lot of people have honed in on, the fact that a Kevin Walsh Fed doesn't seem to be shifting long-term expectations of inflation or even any kind of disruption to the bond market. You could get into a discussion about whether Fed Chair Jay Powell should stay on as governor or not. But do you think that that's notable and actually telling that the market seems to be completely okay with Kevin Walsh as almost a continuity Fed chair?
Right, because we heard the hearing and we didn't hear anything really crazy from Kevin Walsh. I mean, he talked about looking at trimmed PCE. Well, we do look at, the Fed looks at trimmed PCE. Remember core, core, X-core. The Fed does look at a variety of underlying inflation measures. So we heard that from Kevin Walsh, but that's continuity. We heard about no forward guidance. Well, the Fed has been in data-dependent mode for the last few years. I don't think they're actually giving us much forward guidance. He talked about using monetary policy as the primary tool. That's where the Fed is at. I think communication is the one I struggle a little bit with because that is different. And, is that changing the SEP? Is that giving scenarios? I think that's fair. Is that, nobody else speaks other than Fed Chair Walsh? I think then that's different. But we haven't heard that, and it's not clear that that's what he wants. So, yeah, I think, in all the scenarios, I think actually we heard Kevin Walsh's statement said he's credible. He's going to come in. He's got ideas. Every Fed chair comes in with ideas on communication. They make changes, but it's a collegial consensus-building institution. I think that's what they'll do. That's where the market's
But how does Kevin Walsh go on a regime change journey with Jay Powell hovering above him?
I think it's going to be, a discussion-based format. I think Jay Powell, if he stays on as governor, he's going to have a view in it, on that decision. So will every other, I think 18 other members will have a view on how it's done. Certainly 12 in terms of voting decisions, or 11 others beyond Kevin Walsh. So I don't think he overshadows, he's been a governor for a while. He just stays on as a governor with the chair coming up with an idea. And they've debated. The framework review has happened twice. I think they're used to debating, should we be changing communication? Should we be changing the inflation target? They just did that. So I think it'll be somewhat similar.
Priya, good to see you. Lots
Likewise.
to think about. Priya Misra there of JPMorgan Asset Management going into this Fed decision later on this afternoon. Special coverage starts right here on Bloomberg TV at 1:30 Eastern Time. The decision at 2 p.m, the news conference about 30 minutes later.
Yeah, the decision on rates or the decision for Jay Powell? Because ultimately that is going to be the main discussion of what we're going to be talking about later this afternoon.
If institutional credibility is not at risk if he leaves, why is he staying?
Fair question. Maybe he just wants to. Maybe he just loves everybody and really just he enjoys it. He wants to enjoy the fruits of the
I honestly think he wants to go golfing.
We got some time to have this debate.
Fun.
I think he wants to deliver some speeches and make some money.
Right. That's what I think.
I mean, you'd think.
You'd think.
You'd think.
Coming up next, we'll catch up with Sarah Hunt of Alpine, Saxon Woods, Libby Cantrill of Pimco, Chris Maher of OceanFirst Bank. Plus, we'll speak to the former Kansas City Fed President, Esther George.
There's not going to be any family fights. Fed stays on hold.
The resilience of the U.S. consumer is an important factor.
What we're going to hear from Powell is uncertainty.
It's a very difficult situation for anybody to come in and start cutting.
Maybe they cut by the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. And your scores look like this. Equity futures on the S&P 500 bouncing back by just 1/10%. On the Nasdaq, up by 0.3%. In the oil market, commodities look like this. Brent up again. Brent 114 and higher by 3%. And over the last week or so, higher by some 27%. The rally unreal. WTI triple digits. Coming up later, look at the state of this. What a day. Federal Reserve decision, 2 p.m. Eastern Time. 30 minutes later, a news conference. After the close, earnings from Alphabet, Microsoft, Amazon, and Meta.
You know, it's a little too much. I mean, we've got the geopolitics. We've got this question about domestic friction and questions about Fed independence and what is the future of Fed Chair Jay Powell, the soap opera that continues. And then we've got corporate America delivering a $14.3 trillion market cap of just a complete bazooka of earnings after the bell. You put it all together, it's like the crescendo. It'd be a great finale, right, if we were ending and then we could go home and be done. But there is a sense that going forward, this really is all going to hinge on the earnings from the big tech to keep supporting something that otherwise seems to be on shaky ground.
I hate to break it to you. It's April 29th.
Not even May. It feels like a great finale, though, doesn't it?
Bramo feels like we're in Q4.
Yeah.
Ready to take an extended break.
I'm not the only one.
No, I know you're not. This feels like one big, long trading day over the last 3 months. I understand that. The one constant, crude higher. 8 consecutive sessions now. Brent crude up again by close to 3%. 114 and only $4 away from the closing high since this war started.
So obviously this comes as the president is going to continue this blockade, according to the Wall Street Journal. What I find interesting is the Journal reporting is that when the president assessed other options, one would be to escalate, continue bombing, or de-escalate and walk away. Neither the president wants to do. So basically we're in this status quo. As you see, the Iranians really start to pull out a number of levers, like bringing out very old tankers and just trying anywhere to store some crude, store some oil before they are forced to shut-ins. I imagine the White House calculus is give them the hardest, most brutal economic pain and see if that works in terms of diplomacy.
And that move in crude just every single day, just slowly eating away at the bond market. Just every day. Yield's just grinding hard just a little bit more at the long end and the front end. The long end sitting right below, really tight. Just a few basis points away from the highs of the year on 30s, on 2s, up again this morning by 1 or 2 basis points, 385. Going into this Fed meeting this afternoon.
A couple of weeks ago, bond yields were higher, and markedly so, rapidly so, because people expected some sort of central bank response to higher oil prices in the form of rate hikes. Then people said, wait a second, this could potentially suppress growth. This could be more of a growth killer than an inflation shock. And then just slowly, as oil prices have crept higher, we've seen earnings come in stronger than expected and consumers that have been able to absorb some of these price increases. And suddenly it's a 1-2 shock. It's both inflationary and potentially depressive to growth. And that is the quagmire for central banks.
I know there's an obsession about Chairman Powell's future. I understand why. I've got all that. I actually think the more interesting piece of this now is actually the assessment of where we are in this economy, what their outlook looks like, and whether they move to a more symmetrical reaction function to basically articulate that the likelihood of a hike is just as likely there is a cut. I don't know if people will believe them when they say that, but surely the market's going to react if they say that.
Beth Hammack is a voice on the Federal Reserve Board and from the Cleveland Fed, and she has been talking about this symmetric risk more aggressively, talking about the potential for inflation to come back. Do you hear that reflected? And ultimately, is that what the market wants to hear, or will they freak out? And that, I think, will be very interesting as well.
Futures this morning up by 0.1% on the S&P 500. Coming up, we'll catch up with Sarah Hunt of Alpine, Saxon Woods with big tech earnings on deck. Libby, Cantrill of Pimco drops by as the Pentagon's defense budget faces GOP pushback, and the former Kansas City Fed President Esther on the central bank's decision day. We begin this hour with stocks finding their footing on the busiest day of earnings season. Sarah Hunt of Alpine, Saxon Woods writing, AI is the story that keeps on giving. It will be critically important to see how investors react to the announcements made by the mega cap tech stocks later on today. Sarah joins us now for more. Sarah, good morning.
Good morning.
What are you expecting to see this afternoon?
I would love to see everybody say things that are in line with what everyone is expecting on the CapEx front, on everything else. I'd love to see everything come in a way that calms everybody down post the AI story that started yesterday. I don't know what we're going to get. I mean, I suspect from looking at the semiconductors that you should be getting pretty good news, right? So what we've seen so far, it looks like things should be pretty good, but it's it's more critical now because of that AI story, OpenAI story yesterday, that circular argument people get more worried about. So we'll have to see how that plays.
Is inline capex good enough to validate the rally we've seen in semis?
I think so. I mean, they jacked capex up in December, right? So they talked a lot about this in the fourth quarter. I think now you've got that tension because you're seeing people being either laid off or bought out or discussions of layoffs. I think if you go too much higher, you're going to get people starting to worry again whether or not that capex is going to be productive enough, especially if they're laying off employees. So I think that inline is probably the cleanest, most neutral way to go, but we'll have to see how that plays.
One of the most convincing arguments from some of the bears is we just don't know how AI is going to evolve and who's going to be the winner longer term. Do you think we'll get a sense of who's hot and who's not, in the sense of Google's Gemini really picking up some market share, say, versus OpenAI, maybe some of the other chatbots out there, versus Microsoft, which has kind of struggled in some of their cloud adoption compared to Google and AWS?
I think you'll continue to see that differentiation. And I think that that's, again, why it's important that this goes well, just because you have that softness out of OpenAI. If somebody else is picking that up, that's different than everybody else slowing down on growth, right? So there would be a difference there, and people are going to be looking for that because everyone is looking to make sure that this growth is still as strong as it has been. And the bigger you get and the larger the numbers get, the harder that becomes. But I think right now, given what's also happening with energy prices and in Iran, like if the Strait was open, I would say it's probably less of an issue. But because it's still closed, you need to keep that juggernaut moving higher. And right now, that has been very narrowly driving the markets higher.
John's been really good about talking about the cyclical aspects of some of these businesses and what we could hear with respect to Meta, advertising, Amazon, consumer products. Do you think that this will be a cautious moment for them, given some of the rhetoric that we've heard from other officials, which frankly, other executives, I should say, which have been kind of mixed? On one hand, they've had really good earnings. They see a strong consumer. On the other hand, they feel like they have to say, well, things might not continue if things get worse in the Middle East.
Well, and I think that this is the trouble that higher energy prices over a longer period of time start to have, because we've seen good retail sales, we've seen good economic numbers, but the question is, how long can that continue if you are not solving the problem that is really a supply and a Gordian knot problem of everything getting out at the same time and getting back into a cadence of tankers coming out, because all that last landing of oil, which has sort of cushioned all of this, is kind of over. And that's going to be a problem if we don't start to see that resume.
Do you think that's why the oil market is holding on to these gains? They're starting to wake up to the blockade is staying, and we are at the final cushion that they've been building up.
Well, and I think there's been all sorts of regional differentials of crude prices that are not reflected in the futures that we see, that are more the trading sardines and not the eating sardines, right? So I think that there is an issue about different crude differentials across the world and where the refining slates are. And again, this is an issue that, from a logistics standpoint, is going to take some time to play out. So I think it's reasonable to see higher prices for a longer period of time.
Do you think these two stories are connected? Meaning, if all the tech companies do really well today and the market goes higher, would that embolden Trump to be more aggressive in Iran?
Well, it's interesting. It's an interesting question, because I think that I was going to say I'm not sure it matters, but it does matter. There is an attention paid to where financial markets go. And I think that if this had been a slide from when this started, we would be having a different conversation. I'm not sure there's a difference right this minute because we're so close to highs. I think you'd have to see a more sustained problem or more sustained volatility for that to be part of the conversation. But I think that because of where we are, it gives more room.
Let's go back to when we started. So February 27th, the market closed on that Friday. Exxon was trading at 152.50. Let's go back to that Friday, February 27th. And I turn around to you and I say, Sarah, Exxon just closed at 152.50. I'm going to tell you exactly what happens over the next 2 months. The Strait of Hormuz will be shut for the next 2 months. Would you have said that Exxon would be trading at 150.56 at the close as of yesterday?
No.
What's going on there? What does that tell you?
So I think it tells you that there is and I don't think it's a wrong belief, that once you sort out the logistics problems, oil prices are coming down. And you're not bidding up the oil producers right now because you think this is a temporary spike in prices. And companies never get credit when they're over-earning for some reason that people think is temporary. So if you think about anything that's a commodity, if you have higher chemical prices for a period of time, they don't get the credit for higher prices and higher earnings, because people expect the earnings in the out years to come down. I think there's an expectation that when you've solved the logistics, we were not short of oil before this started. We need all the energy because we're building all these data centers and we need all the things. But oil wasn't in, the supply shock is not because we have demand so high that we don't have enough supply. The supply shock is we can't get it. And I think the expectation is that's not going to change that rapidly. And so you're not bidding up the big producers.
There's a point that some of the guests on the show have made, which is the longer this goes on, the more that structural demand for oil will go down over the long term. People will look for other ways to diversify away from being so dependent on these particular producers. Is the price action that John was talking about sussing this out in any capacity?
I know. So I would push back on that a little bit. And I would say that I think that because we have so much of a high demand for energy overall, yes, you have temporary swings and you have people switching to EVs, but that's not going to be, I don't think, on the margin enough to make that change. You would have to have a much more sustained drop in demand for it. You'd have to have you'd have to be able to swap out jet fuel, right? You can't swap out jet fuel. You can't, there's certain transportation fuels, and oil is generally speaking more used for transportation than for generating electricity. So I think that that's a little bit premature until we have a substitute that you can really count on in volume. And right now, I don't think we have that.
Sarah, good to see you. Thanks for dropping by. Thank you. What a day ahead we've got. Sarah Hunt there of Alpine Saxon Woods. Brent crude this morning just short of 115. With an update on stories worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Trump telling his staff to prepare for an extended U.S. naval blockade of the Strait of Hormuz. The Wall Street Journal reporting the president has decided the blockade is a less risky option than resuming bombing or extracting the U.S. from the conflict entirely. The FCC is starting a review of the TV station licenses owned by Disney's ABC network over potential unlawful discrimination tied to the Commission's inquiry into Disney's DEI practices. The 8 Disney-owned stations are directed to file license renewals at least 2 years earlier than otherwise required. The State Department will offer a new version of U.S. passports featuring a picture of President Donald Trump inside to commemorate the 250th anniversary of American independence. The picture of Trump will be on one of the inside pages with the president's signature in gold appearing below. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie later this hour. Up next on the programme, unmatched military spending.
We have the most powerful, most lethal, most sophisticated, and most fearsome. It's a fearsome military on planet Earth.
There's a bit of pushback down in Washington. We'll get to that story with Libby Cantrill of Pimco. Live from New York City this morning. Good morning. Small bounce this morning. Equities higher by 0.1% on the S&P 500. On the Nasdaq up by 0.4. What an afternoon coming up for the Nasdaq 100. Four of the biggest companies on the planet reporting earnings later. Bramo's upset. She thinks you should spread it out. Tuesday through Friday.
I just think every company should get its due, considering that each one of these is a huge component of our economy, so they each should get their moment in the sun. I love that we're talking with Sarah Hunt just a minute ago. You said, what's the best case scenario? She said, we get no news. It's everything's in line and we can just keep going. And that ultimately, I get it. But also, if they were all doing separately, then we'd be interested in all
Priya say the same thing about the Federal Reserve?
People just
That's the goal for Chairman Powell.
They want
a no-news afternoon.
Yeah, which is just not going to happen.
With a schedule like this one.
I'm actually really excited, but I do think spread the love.
Let's turn to commodities. Brent crude up for an 8th consecutive session now. We're higher over that period by close to 27%. Brent this morning at 114.60 and higher today by 3%. Under surveillance this morning, unmatched military spending.
We have the most powerful, most lethal, most sophisticated, and most fearsome. It's a fearsome military on planet Earth. We have the strongest and most powerful by far military in the world. We have the greatest military in the world by far. Our military is unsurpassed. There's never been anything like it. Nobody's ever seen anything like it.
So here's the latest this morning. The Defense Secretary Pete Hegseth heading to Capitol Hill to defend President Trump's $1.5 trillion defense budget as it faces bipartisan pushback down in Washington, D.C. Joining us now for more, Tyler Kendall. Morning, Tyler.
Hey, John, good morning. Well, the White House is asking for the largest single-year increase of the Pentagon's budget since World War II. But Republican aides tell me this is just a request. We should view it more as a guidepost on where priorities are. And if we look at the fuller picture of President Trump's budget proposal, we are seeing a massive defense buildup paid in part by cuts to domestic agencies. And that could potentially set up some political risk as we head into the midterms and against the backdrop of an Iran war that is causing consumers to pay higher gas prices. And that could be part of why we're starting to see some uncertainty from Republicans when it comes to this budget proposal, including the Senate's top appropriator, Susan Collins, who has previously supported hefty defense increases, but now finds herself in a tight re-election race. We're also hearing some concerns from conservatives when it comes to the idea that they would need to see more offsets if there's going to be more spending. But again, that could set up some political risk. Plus, some other lawmakers are now floating the idea that they could condition their vote on more spending if Congress is able to get a vote to authorize the war in Iran as we approach that 60-day mark. Now, keep in mind here, this is the president's fiscal year budget request. We're not even talking about an expected supplemental request from the administration, maybe in the range of $50 billion. We've gotten a few different reporting and talk about it from lawmakers. But, John, that may be the fastest and easiest way to surge more funds to the Pentagon because, by and large, Republicans do support the president's military aims.
Tyler Cantrill down in Washington. Tyler, thank you. Let's build on this conversation. Pleased to say, joining us around the table, good friend of this programme, Libby Cantrill of Pimco. Libby, good morning.
Good morning.
We've lost all appreciation for how big these numbers are. What's their track record of understanding where the 1 trillion goes, never mind the 1.5?
Yeah, I mean, I think as Tyler said, I mean, this is basically sort of reflective of the president's wish list. This is an opening bid, if you will. The budget is, kind of suggests what the president's priorities are. But we should also realize that it is going to, the actual spend, the actual appropriation for defense come for FY27 is going to be much smaller. Historically, this has been, as Annmarie knows, sort of $800 billion, up to $1 trillion of defense spending as of last year. A $1.5 trillion spending. Again, this is like pie in the sky kind of things. It's really to frame the negotiation. I think it does emphasize, though, it underscores how important the defense component is, maybe surprisingly, to this administration. So again, I think we should take this with a grain of salt. Our view is that we probably see maybe a small tick up in terms of defense spending. That would land around $1 trillion, obviously much short of the $1.5 trillion.
Do they have to get this done before the midterms?
Yeah, I mean, look, as you know, the end of the fiscal year is September 30th. Oftentimes, they're operating under something called a continuing resolution, as we all know, which is basically just a stopgap funding bill. Does this get a lot harder? I mean, maybe they get to do it in the lame duck, which is, of course, the period after the election before the end of this Congress. But look, I think that just in general, after the midterm elections, things are just going to get much more difficult for the Republicans. So any of these things that feel pretty ambitious, they should be trying to get done. The real story, I think, on Capitol Hill right now is just the lack of real progress in anything. Even though Republicans control both chambers of Congress, there is just very little movement on things that are FISA, the Farm Bill. I mean, things are kind of like the blocking and tackling of Congress, but I think does represent the fact that it's really difficult to get things done with small majorities, even when one party controls both chambers.
Well, also what's interesting about today is not just the defense budget request, but also Pete Hegseth is going to be really in the hot seat. And I've heard rumors that he's been kind of on thin ice. There's been mixed feelings about how Republicans in Congress feel about him. Do you think this is potentially a huge moment for him on whether or not the president decides to keep him on as his defense secretary?
Well, look, I think you're absolutely right. He is going to get a lot of pressure. I think a lot of Republicans, while publicly they're supporting this Iranian conflict, privately, there's some growing skepticism about how long we're in this, what the strategic objectives are, what the sort of framework for success is. And as you know, there's this War Powers Act that could require Congress to actually authorize this conflict in Iran. So I think you're going to get a lot of pushback on him, more just trying to get details about what the strategy is. In terms of, his future in the cabinet, I mean, it's an open question for anybody in any administration. I will say, though, as you get closer to the midterms and as we're looking at potentially either a narrower Republican margin in the Senate or even potentially the Senate flipping to Democratic control, there will be pressure for folks to go so the president can renominate people while the Republicans still, have the existing majority in the Senate.
Still trying to wrap my head around $1.5 trillion, a 44% increase in the defense spending. I mean, this to me highlights just how high the bar is to get anyone concerned about fiscal issues. I mean, given the fact that our debt to GDP is right there behind Maldives, Bahrain, Greece, and Sudan, here we are. So it just raises this issue. At what point will people start actually pushing back and saying, wait a second, we're supposed to care about the deficit. When are we going to do that again?
Lisa, I love the fact that you care about the deficits as much as we do at Pimco. Yes, I mean, we talk about the deficits a lot. And we're talking a lot to our clients, of course, a lot about it. I think as we have said many times before, the Treasury bonds benefit from this idea of like the cleanest dirty shirt, that like all of your shirts are dirty in the sort of sovereign bond closet, but the Treasuries continue to be the cleanest dirty shirt. And that is still true, right? The U.S. still has the most dynamic, most sort of innovative economy. It's the most liquid and deep bond market. However, we're hearing from clients, both in the U.S. and overseas, of these sort of continued worries, not only in the U.S., of course, but in other developed countries. But in the U.S., and as I've been saying, sort of Congress will keep on dancing as long as the music is playing. And if the bond market is not a constraint, then what is a constraint? Not to get too wonky here, but I think one thing just to have on your radar is I would assume this would be an issue in 2028 because the Social Security Trust Fund is supposed to go bankrupt, meaning it will pay out less than it brings in 2033. That may feel like far away. It's really not. And so policymakers are going to have to start talking about this. I would be surprised if this is not a presidential election, be still our heart, that we actually start talking about deficits. But in between then, 6 to 7% deficits, 6-7% deficits as a percentage of GDP. I mean, this is very high, and we're not even in a recession, and we're really not at war. So, yes, I mean, we hear you, we share your concerns.
Thank you. I feel heard.
But again, I just don't think that unless the bond market is going to be the constraint, and there's some concerns at the long end, but it really has not been that kind of that constraint.
How much is this a big point in the Kevin Warsh nomination and any kind of Fed Treasury accord, especially given the fact that the Treasury is shifting away from long-term issuance, issuing more on the front end, and we're talking about ways to potentially lower rates on the front end?
Yeah, look, I mean, I think we would be, I think we'll sort of have to wait and see in terms of this accord. There's only so much, of course, that Kevin Warsh can do as chair. The chair is important, but not omnipotent, meaning like the power of persuasion is important in terms of the chair position, but he's only one vote. And as it relates to the balance sheet, he's only one vote of 12. And he's, of course, only one vote of 12 on rates as well. So, we'll just sort of see what he can do in terms of the balance sheet. And then, the Treasury is increasing their buyback program. That is something that they have been doing. But there's also a limit there, right? They do not have a balance sheet. It has to be balance sheet neutral. So there's only so much they can do in terms of, buybacks and what have you without really affecting the weighted average maturity of Treasury bonds.
Just
We're getting
quickly,
really wonky here.
Your base case, just
Love
a
it.
basic question. Middle of May, does Chairman Powell step away?
Again, open question. I think he will need to have every confidence in the world that this investigation, I think both at the Fed in terms of the IG investigation and then also at the DOJ, is put to bed. My view, my guess, my speculation is it would make sense if he were to stay beyond the midterms, just to sort of see what that. Again, I'm not trying to make news here. This is just a guess.
Okay.
But it would
already out.
But you think if you're worried about Fed independence, you're going to really want to see what that Senate majority looks like. And of course, then it also gives you some time with Kevin Warsh as well. So I just think, but the big point here is, does it really matter? And the Fed is boxed in here in terms of the macroeconomic conditions. And a Kevin Warsh Fed, a Powell Fed, I guess in the next few months will look that different. I'm just not sure if the inflation numbers and the growth numbers will really allow them to just take too much of a different posture.
Libby, appreciate your time.
Thanks.
Thank you for the deficit therapy as well. Libby Cantrill there of Pimco.
Thank you.
I forget which congressman it was, but I think he said something like, we've been throwing Ferraris at Frisbees in the Middle East.
Well, this is the issue, right? How much? She's spending $1 million for a $5,000 drone?
Right.
Got to stop that.
Up next, we'll catch up with OceanFirst Bank CEO Chris Maher as AI fears return ahead of big tech earnings later this afternoon. Futures just about positive. What a day ahead we've got ahead of us. I'll get my words out. Equity futures right now on the S&P up by 0.1%. On the Nasdaq, we're up by 0.3%. What a run we're seeing in crude. 8 days of gains for Brent. Brent crude on the longest winning streak since 2022, May of that year, I believe. Just short of 115 this morning on Brent, up by 3%, and just short of the closing high of the year so far, which was 118. In the bond market, when you see those kind of moves, you just fold it into fixed income. Drifting high at the front end of the curve, again up by close to 2 basis points. Twos at 385, heading into this Fed meeting this afternoon.
Yeah, to me, I think the 1-2 punch is actually going to be really interesting. At what point do you start hearing companies be concerned about the inflationary hit from higher oil prices that then goes into either reduced demand or them jacking up prices and being able to charge more? And that might give the answer to the Federal Reserve. In some ways, the answer will be decided for the Fed by the companies and the policy and what goes on in the geopolitics more than by the Fed itself.
Have you noticed everyone dancing around the Chairman Powell issue today? It's been fairly entertaining.
You mean in terms of what they do and don't want to say?
Yeah.
They don't want to really weigh in on this in any capacity?
Libby was talking about him maybe staying beyond the midterms.
But, she doesn't really want to
see
make
what
headlines.
happens in the midterms.
There is a sense, well, there are twofold issues. Number one, he wants to immunize himself from potential legal probes, so he doesn't want to necessarily get hinged. And if he stays on, it might immunize him a little bit more. And number two, there's a feeling that maybe there's going to be a padding out of the Fed or some kind of other issue that he's trying to avoid. That's my sense.
We're not political, but we're waiting for the consequences and the outcome of a political vote later this year.
Well, you can get into this argument, and that's why people don't want to, because it's just
already
fraud.
Political.
Well, right, but it's fraud, and there's no real market upside for them to talk about it, just like there's no real upside for me to talk about it.
Priya earlier was talking about him potentially leaving. And if he left, it wouldn't damage institutional credibility anyway, because that remains intact. So why are we talking about him staying? Why does he need to stay?
I guess these are all questions that need to be asked today at the news conference, and maybe they can all be hashed out.
So you don't want to go there?
Well, I don't have really a hard feeling on it. I think that you have more passionate feelings about it, and I'm looking at what's the market reaction, and I'm not sure what the market reaction is going to be. And otherwise, honestly, let's just get on with it.
The DOJ dropped the probe. The Inspector General is going to look into it. I do think he has an off-ramp to take today. So if he doesn't, he will look political.
His bar, his metric is with transparency and finality. And maybe he decides that we haven't met that bar. And that's really the question, I think, for this afternoon.
And what types of continuing probes is he going to be looking for to be dropped, potentially exit stage left? Look, it's a valid question. I'm not undermining it.
I'll get Bramo's opinion by the end of the show. We'll just keep.
We're having a vote today at the Senate Banking Committee for Kevin Warsh that 2 Democrats might vote for him. If there's a bipartisan vote for the incoming Fed chair, then why is he sticking around?
He's got establishment support, right?
Yeah, well, and market support, too, if you actually take it with any credibility.
We'll get there eventually. 2 hours away from the cash open this morning with your morning movers, Yahira has more. Hey, Yahira.
Hi, John. The bar was pretty high for Humana going into earnings because the insurance industry has been doing pretty well, including due to improving cost trends. So even though the company beat on earnings, it is holding its guidance steady, and that is not landing well. So shares are down 0.75%. Moving on to Starbucks, those shares are rising nearly 5% in the pre-market as the turnaround takes hold due to the U.S. consumer showing up in force, helping the coffee chain beat expectations and boosting its outlook, even as China remains a weak spot. But overall, CEO Brian Nichols saying that more customers are visiting their stores, and when they're there, they are spending more. And take a look at Robinhood shares. They are plunging down more than 11% in the pre-market, revenue coming in light. And the story there really has to do with the retail investor pulling back amid volatility due to the Iran war. You also have Robinhood saying that their expenses jumped and warning that its involvement in Trump accounts will involve another $100 million in investment. John.
Yahira, thank you. More from Yahira in the next hour. On our radar this morning, President Donald Trump telling aides to prepare for an extended naval blockade of the Strait of Hormuz. The Wall Street Journal reporting the president thinks the blockade carries less risk than resuming hostilities. Elsewhere, it's the busiest day of the current earnings season with more than $14 trillion in market cap reporting, including results from 4 of the Mag 7. Alphabet, Microsoft, Amazon and Meta reporting after the closing bell. And finally, the Senate Banking Committee likely to approve Kevin Warsh's nomination for Fed chair in a vote later this morning. If Warsh clears the panel, his nomination will head to the full Senate for a final confirmation vote.
Can you imagine if he also gets confirmed today and then heads over to the Fed and says, I'm going to sit here too. Guess what? I'm Fed chair now.
Washington doesn't move that quickly.
Okay, well, make it really dramatic. We could really increase the drama of this finale.
Well, Mohammed El-Arian is putting out on Twitter that really what matters more is going to be the politics. Will Chair Powell repeat the defiant tone of his dramatic January video? And I think that's why this is important. Jay Powell could make this about himself if he stays on as governor and less about the institution. And I think it'll be incredibly interesting if he decides that he's going to announce he's staying on when there, as I just said, potentially bipartisan support for Kevin Warsh out of the Senate Banking Committee.
It risks creating a dependency issue when there isn't one. I also think the way they talk about the Federal Reserve right now undermines the people already on the FOMC. This is not the Supreme Court. This is the Federal Reserve. And just breaking down the board by who the president has appointed and who he hasn't isn't really how this works. And I think it throws a lot of mud at the otherwise fantastic work that the likes of Governor Waller, who was also nominated by this president in his first term, is doing at the Federal Reserve. This is not the Supreme Court. Other people have opinions on the future of this institution. It's a deliberative body that come up to decisions in a way that we weren't maybe 20, 30 years ago when one man set the tone for the whole committee. That's changed. I don't see it flipping back to that anytime soon.
It's a fair point. He has to articulate what concerns him that would require him to stay on. And I think that is sort of the key point. I will say, Stephen Myron, this is going to be his last time at the Federal Reserve. Then his term is up, and that's who Kevin Warsh would be replacing. So there are a number of moving pieces here that we have to consider.
Exactly. That was going to be my next point. Spare a thought for Governor Myron. Whether or not he has a job or not depends on what Powell might say today, because he can potentially stay and take Powell's seat. But if Powell stays on, and maybe that's what this is actually all about. Maybe Jay Powell actually doesn't want Myron to stay at the Fed. So he says, I'm going to stay a little bit longer. Maybe Myron goes out and gets a new job and doesn't wait around for Powell to leave.
Today's going to be a long day. We'll have more time to talk about this. Let's talk about those tech earnings. Coming as a new wave of AI anxiety leaves investors questioning the CapEx spend. OceanFirst Bank Chairman and CEO Christopher Maher, I'm pleased to say, joins us around the table. Chris, good morning. Good to see you.
Morning, John. Great to be here.
Is this the real deal? So we've got these doubts about OpenAI and their spending commitments because they're not seeing the internal growth and they're falling short of their own targets internally. Do you think it's the real deal? Are you seeing the kind of growth that you'd expect from this kind of technology?
Well, we're certainly seeing it. We're seeing it not only within our own firm, our peers, our clients. You're seeing these dramatic improvements in your ability to produce. Not just, there's a lot of focus on the AI itself, this decision engines and, but as important as that is this revolution in the way you build technology from a coding perspective. So we're seeing our engineers able to be dramatically more productive than they've ever been. So you can automate things you would never have considered automating before. And we're seeing really important gains, things where we're taking 75, 80% of the time out of a process, which improves the experience for our clients, makes things less expensive for us, but it's on both sides, not just decisioning.
I'm going to reduce this in a really crude fashion, so forgive me, but ultimately this is the focus. Revenue growth relative to the size of the workforce. Are you going to get more from the same size of the workforce, or are you going to get more from even less? How do you think about the trade-off between the two?
You're certainly going to get more for the same size of the workforce. So when I think about our bank, when I joined, we had about $10 million in assets per employee. You just think about that as a crude measure of efficiency. We're now at 16 million. I think we're going to be north of 20 million within the next 6 to 12 months. So it's a huge opportunity for you to run an operation much more effectively.
Is there a limit to how much people are willing to invest if the costs go up? And I'm talking about the component costs. I'm talking about just the commodity costs, as well as just the supply-demand dynamics.
Lisa, I think that when you look at everything that goes into a data center, and it's everything from chips to concrete and steel and plumbing and heating and cooling, I think we're going to have a choppy period over the next year or two as we balance out what investments make sense and what the true cost of this technology is. I think we often overlook that the price we pay for AI today has no relation to the cost to deliver it. So when you think about, in a fully formed way, with all these data centers up and the energy costs, what is the cost per query? What is the cost? Right now, it's kind of a subsidized thing where we're getting access to the technology very inexpensively. So as those fully burdened capital costs come through, we're going to see how effective it is.
Well, this is the reason why some people are looking and saying, well, on one hand, CapEx is good things. It represents some kind of promise. On the other hand, are we just paying continually more for the same amount, given the fact that prices are going up in a significant way? I mean, at what point does that become a constraint in the markets?
I think the most important short-term constraint, what we hear from our clients, and our clients are everywhere from DC to Boston, a lot of different industries, is they're very concerned about energy costs broadly. So yes, it's oil, but it's also the electricity costs going up. And when they look at that input cost and traveling through their corporations, and it's going to raise the price of everything. So energy is a really big conversation. It is a bigger conversation among our customers than employment is. And that, you would typically, they would always complain about employment, but they're worried about energy.
And the conflict in Iran is just making that worse. Are we going to hear more of that today from the hyperscalers?
Yeah, Annmarie, I wouldn't be surprised because when you think about not just the data centers kind of sucking up all this electricity, oil on top of that, and then these multiplier effects that those costs then just creep their way into the logistics systems and they make everything more expensive. So that's the concern.
When you look at this space, what do you make of Anthropic and OpenAI? Is it hype? Is it ahead of their IPOs, or is this real?
Well, we kind of go back and forth. I think it's real. I don't think it's going to have a uniform impact on everything that people think it is. So everything, it's going to solve world hunger and all that. I don't think it's going to do that. But it is very broad-based. We see our employees just experimenting with things, bringing stuff to us. Mythos is frightening. When you think about the security posture of your company and the ability for the bad guys to be that much more effective. So yeah, we got a lot to stay awake on.
Do you think it will help your institution become more resilient or expose potentially some vulnerabilities in the industry?
I think in the long term, it helps you become much more resilient. The pitfalls in the short term, right, is you're adopting this stuff, and is there kind of a short-term issue that pops up that you've got to deal with? But we've seen our cyber posture over the last several years. These tools are really helpful because you can't keep up anymore. You're getting attacked in a way that a human being cannot respond to, right? We've got these automated scripts to respond on things. So technology is both your friend and your adversary.
Chris, it's good to see you. Thanks for breaking it down. Thank you, sir. Thank you. OceanFirst Bank Chairman and CEO. Christopher Maher, things moving very, very quickly. We mentioned this earlier, that 12 months ago, Alphabet was dead. It was all about OpenAI. Then Anthropic's taken over. Alphabet's really flourishing. And I wonder where we'll be 12 months from now.
And how much does it really hinge on capital markets remaining open so people can keep borrowing money or raising money in other fashions to keep investing in things that may change, but ultimately will protect them from some of the cyber risks and will insulate them from some of the costs from supply chains that they can overcome with efficiencies of scale.
Nasdaq futures this morning higher by 0.3% with an update on stories worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Yum Brands edging lower in pre-market trading after beating expectations for the first quarter on the top and bottom lines. Same-store sales grew 8%, thanks in large part to Taco Bell's value meals, offsetting more tepid results from its other brands. Elon Musk taking the stand in his case against OpenAI. Musk is suing Sam Altman's company because he says its pivot from a charity to a for-profit business is wrong. An attorney for OpenAI says Musk's lawsuit is an attempt to undermine a competitor to his own company, xAI. UBS CEO Sergio Ermotti speaking with Bloomberg's Guy Johnson today, warning financial markets are at risk of over-optimism regarding the Iran conflict.
The expectations is not only that things are going to be resolved, which we believe and hope they're going to be resolved, but the impact of what happened will be resolved in a classical way we saw in the last 10 years, V-shaped. Everything is going to go back into normality.
Equity markets have risen to records even without a clear off-ramp for the conflict with Iran. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in 30 minutes. Up next on the programme, bracing for change.
The momentum of the economy is there. It will probably sustain itself, broaden in the second half of the year. If that happens, and not only does inflation not fall, but maybe starts to rise, we're going to see a very, very different tone from the Fed.
In just a moment, we'll catch up with the former Kansas City Fed President, Esther George, live from New York City. You're watching Bloomberg TV. Here's the shape of things this morning. Equity futures just about unchanged on the S&P 500, positive on the Nasdaq following yesterday's losses. Yesterday on the S&P, the biggest one-day loss we've seen in about a week. Notable that we're seeing the equal weight decline. Lisa talked about that earlier this morning. 6 consecutive days of weakness there, lower across those 6 days. That's the longest streak we've seen so far this year. And with that, this move in crude, 8 consecutive days of gains for Brent. That's the longest this year. That's the longest daily rally we've seen going back to May of 2022. Higher by 3% at 114, round it up to 115. That's unsettling some things in the bond market at the front end of the curve. Yields just drifting higher. I've called this stealthy because it's been quiet, this sell-off in bonds. But we're building and building and building and retesting the highs of the year so far at the long end of the curve. And at the front end, up another 2 basis points, 386.
It's a good characterization. Yesterday, there was a 7-year auction, and it just tailed a little bit. It just wasn't great. And that's sort of how all the auctions have been of late, highlighting how people don't know how to price what is an ongoing, slow-moving crisis, potentially, in the works, which is the oil price, and exactly how the economy will adjust to it. When does it become inflationary, and when does it switch over to disinflationary because of demand destruction?
Those moves going into the Federal Reserve decision later on this afternoon, under surveillance this morning, bracing for change.
The Fed feel very strongly that the excess inflation that we have right now, that the bulk of that is coming from tariffs, and that should be fading over time. The momentum of the economy is there. It will probably sustain itself, broaden in the second half of the year. If that happens, and not only does inflation not fall, but maybe starts to rise, we're going to see a very, very different tone from the Fed.
So here's the latest this morning. Investors looking for signals on how long the central bank will stay on hold at what is likely to be Jay Powell's final meeting as chair. Joining us now to discuss is former Kansas City Fed President Esther George. Esther, a warm welcome back to the program, as always. At 2 p.m. Eastern Time, we get a decision. 30 minutes later, a news conference. What are you expecting to hear?
Well, good morning, Jonathan. I think it's clear the table is set for today's meeting, and the real question is not will they move rates? It seems likely they will remain on hold. But I think the question is, how will they describe the outlook in this time of high uncertainty? Will they lean into the inflation issues that we've heard a number of the FOMC members talk about? Will they think about two-sided risk, if you will, to their mandates? And of course, the other part of the discussion, people are leaning in very heavily on trying to understand how the chairman might be thinking about his future role.
Esther, none of that is normal. That last point in particular is not normal. You know how this works typically. They move aside, someone else comes on board, we move on with life. Why is this moment so different?
Well, because it's been wrapped up in a bit of political fury, if you will. The chairman has had...
I think we've lost that line to Esther George, the former Kansas City Fed president, on an important moment for the future of the chairman of the Federal Reserve.
That's so much. She doesn't want to talk about it. I mean, I think
no one wants to talk about it.
I think that we should do that next time you ask me about it. I'll just sort of freeze.
Freeze frame.
Maybe you guys will too. Ultimately, it's a difficult moment because people are used to talking about a difficult economic moment that we're in, and instead we're having to suss out exactly whether it is going to be important for him to stay on, whether it will matter to markets. Right now, the market seems to be incredibly calm.
She stopped, and the shot was frozen. It was a technical issue, but when she was talking about political fury when it comes to Jay Powell, and you know what this is going to do, right? The conspiracy theorists out there in financial markets are going to be seeing that, and they're going to say there's a reason why she was frozen.
The fact that we're even talking about this is a problem. It's a big problem. And understand it's not just the chairman's responsibility to handle this issue. The blame lays at the feet of this administration as well for introducing this as even a conversation. We've talked about this all year. This could have been very straightforward. You've appointed your guy. Move on with life. Kevin Warsh runs the Federal Reserve. A new outlook for the central bank. We're here because no one wanted to take the off-ramp. They just kept pursuing it, pursuing it, pursuing it. And I've mentioned this a few times. 12 months ago, when we were looking out 1 year, and we were thinking about what the future of this conversation would look like around the Federal Reserve, we were talking about a shadow Fed chair, the likes of a Kevin Warsh maybe, getting confirmed early, so we knew that he was going to be there in the wings. And that was the ultimate story. This wasn't even a consideration, the idea that Chairman Powell would stick around to 28 on the board.
Part of the reason why we're talking about this so much is President Trump is a real estate guy. He's a real estate developer. He wants rates lower, and we're dealing with a significant amount of debt in this country, and it is much more beneficial for the rates to be significantly lower. How do you accomplish that? Increasingly becomes the question in one supply chain shock after another that really does challenge the discussion, even though we are having disinflation on other measures. So it is a complicated economic discussion that has been brought into the mainstream by President Trump and produced in utterly dramatic fashion so that everybody can really play a part in this Bachelor Fed style.
And he was fanning the flames throughout the entire year and into this year. I mean, I was in the Oval Office that morning when there was reports that maybe he was going to fire Jay Powell. And that was really just mostly about the fact that he didn't think he was doing a good job, less so even about what was going on when it comes to the refurbishment. Then they went to the refurb. Remember, this was a president who went to the Fed, sat behind, alongside the chair, looking at all the work that was being done at the Federal Reserve. So there's been a lot to this story.
I believe we've re-established that connection, and at risk of offering any fuel to conspiracy theories, I hope Esther George is still with us. Esther, we want you to complete your thoughts on the future of Chairman Powell and why this moment is so different.
Well, it's different, Jonathan, because, again, we have not seen this kind of political angst around a transition of leadership in the way that we have now. And of course, this follows on a long period of badgering of the Fed about its interest rate stance. And so it creates an environment right now that is unusual. Having said that, though, the institution, I think, is quite capable of carrying forward during this transition. And really, as I think about the committee and what they're doing this morning, I suspect they are squarely focused on the economic challenges and deciding what their stance of policy needs to be.
Couldn't agree more. Esther, it's good to see you. My apologies that this one's a bit of a short one. We'll get you back on the schedule soon and we'll catch up. The former Kansas City Fed President, Esther George, on the future of this institution and the focus on the Fed later on this afternoon, which unfortunately is not just about policy, the outlook, the economic challenges. It's also about the future of the chairman of the Federal Reserve.
I like what she did there. She said it's a committee, and she kept emphasizing the committee. And at what point do we have that emphasis rather than on one person who is the head of that committee, but ultimately is really held to the consensus vote of 12 individuals?
Right, it's a deliberative body, which is why people say, well, if Chair Powell stays on, he's just one person. But at the same time, he was the head of this institution. So if he stays on, doesn't that make it a little bit more complicated if Kevin Warsh comes in and wants a quote-unquote regime change?
I go back to two words, transparency and finality. It doesn't really matter what I think about any of this. I think the chairman set up his own metric for whether he can move on or not. He said it needs to be wrapped up with transparency and finality. And based on that metric, I believe where we are right now falls short of that bar. So it'll be interesting to see how the chairman navigates that later this afternoon.
Yeah, maybe he'll have a technical difficulty and just freeze.
Just cut off the news conference.
Everyone just has to leave. You know, there are different ways to handle this.
True. Just pull the plug.
See. Yeah, exactly.
Yeah, OK. Let's hope they don't do that, because we're going to have quite a long time to talk about nothing.
Yeah, OK, all right. Please don't do that. That's a terrible option.
News conference, 2:30 Eastern Time. Don't pull the plug, OK? Our coverage starts at 1:30. It wraps up several hours later. Coming up on this programme, Stuart Kaiser of Citi, Shweta Khajuria of Wolfe Research, Tom Porcelli of Wells Fargo, the IAEA Director General, Rafael Grossi. Looking forward to that in the next hour of Bloomberg Surveillance, the third hour, just around the corner.
The market remains dependent on tech.
The CapEx figure is what you got to be laser focused on.
We're just really not seeing the rest of the market able to overtake that Mag 7 cohort.
Tech breadth is broadening across the sector.
The technology genie comes out of the bottle. It never goes back in.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Equity futures on the S&P 500 just about positive. On the Nasdaq, up by 0.3. In the commodity market, up again on Brent for an 8th consecutive session, up by more than 3% and just short of 115. Heading into this day ahead, What a day ahead. Later on this afternoon, a Federal Reserve decision. 30 minutes later, a news conference. Then after the close, these names right here, the biggest companies on the planet reporting earnings: Alphabet, Microsoft, Amazon, Meta.
So you've got your geopolitical crisis, a question around how much the drip feed of higher oil prices are going to torpedo the economy and perhaps drive the hot war back into action. You've got domestic drama with the Federal Reserve. What is going to happen there? Not necessarily with interest rates, but with respect to the personnel. And then corporate America really delivers the bazooka, which is how well are the big tech names doing, given the fact that they have driven the rally not only in equities, but in economic optimism.
Well, let's start with the geopolitics, the squeeze in the Middle East and the moves in crude. The Wall Street Journal with this: the president instructing aides to prepare for an extended blockade of Iran, according to U.S. officials.
Blockade in hopes that the Iranians cave. That is what the president is deciding to do. And if you continue to read the Wall Street Journal report, it goes on to say that the other options of either escalating to start strikes again or de-escalating, basically just walking away and saying, we reached some of our targets, we're now going to leave because we don't want this impact on the oil market, the president is not willing to accept. So right now, I think the oil market is starting to wake up to the fact that we've already drawn down a number of inventories, and the president is serious, and the blockade is not ending right now. And you can see that as well, what is going on in the Strait of Hormuz, what the Iranians are trying to do in terms of putting any last barrel of oil somewhere to store.
You can see it through the pricing of the futures curve. Lisa's been on top of this all week. New highs for long-dated contracts this morning at the front end of the curve, just several dollars away from the highs of the year.
Yeah, you pointed out the fact that we all made such a big deal about Goldman increasing their forecast to $90 a barrel at the end of the year. And guess what? If you take a look at the December contract for Brent crude, we're at 88. So to your point, we're already there, and yet people don't seem to be paying attention if they're in the equity markets, at least not on the index level. Is this a boiling the frog moment where we reach a point where suddenly the frog's dead? And that ultimately is what people are looking at, even though it's not very nice.
Stu, how do you feel? Welcome to the program.
Well, it's a bad for the frog, apparently.
Look, a warm welcome to Bloomberg Surveillance, sir.
Definitely.
You take a beat. Coming up this hour, Stuart Kaiser of Citi, ahead of mega cap tech quarterly earnings. Tom Porcelli of Wells Fargo previewing today's Fed decision. And the IAEA Director General Rafael Grossi as US-Iran talks stall over Tehran's nuclear program. Conversation about nuclear war at the end of the program with Bramo, so that should be fun. All right, we begin this hour with stocks edging higher as Wall Street braces for a busy 48 hours. Stuart Kaiser of Citi writing the following: tech stocks are priced for large upside moves. April 30th is effectively the largest day for S&P 500 earnings since 2012. A warm welcome to you, Stuart. A proper welcome. It's good to see you, buddy.
Thank you. It's good to be here.
We've been talking about your notes throughout the week. Lisa has. These slow-moving risks could turn what you say is non-linear if they persist. Are we close to that tipping point?
I mean, it does feel like it. Our commodity strategists think if this lasts, a couple more weeks, you're at $110, and if it lasts, call it a month after that, you're at 130 on TI, and that I think becomes a real issue for equity markets. I think what equity markets have tried to do is generally with the Middle East is compartmentalize it, and as long as oil doesn't tap us on the shoulder and say you need to worry, we're just going to trade AI and be pretty, bullish, optimistic folks.
Are you feeling that tap just a little bit more this week?
It's getting there. I think it's very interesting because of the FOMC and because of large cap tech earnings, that's just dominating conversation. But we are getting the incomings of what do I focus on after, after Wednesday and Thursday? And if, unfortunately, what we're focusing on is $120 of oil, then I think it can become an issue for equity markets at that point.
Is it a price level or is it a length of time? Which one?
I personally think it's a length of time, type issue. If you go back to 2022, you had WTI above $100 for 87 out of 102 trading days or something on that order. And equity markets were able to kind of survive that because the long-term oil never really inflected. I think you guys are hitting on the right thing, which is if I'm looking at that 18 to 24-month outlook, as that creeps higher, that's where you get worried. I do think this is definitely an issue of time, especially now that the kind of shooting has calmed down a little bit.
Not to ask you to have a crystal ball, but how long? Because people were saying back at the beginning, and John and Annmarie have been talking about this a couple of weeks. Now we're 2 months in, and suddenly the blockade's going to be even there longer. At what point does it really hit that trigger where all of a sudden people say, wait a second, we're going to go back to focusing on that?
Look, I think the issue is, or at the beginning of this, I think the administration was very cognizant of trying to keep oil contained, right? They were allowing Iran to export. They took the tariffs off of some of the Russian exports, et cetera. Now it seems like they're sort of going the other way a little bit because the goal of the blockade is to shut this in. And I actually agree with the blockade in the sense that it's sort of nonviolent escalation. And I think that's where President Trump probably wants to be. So now it's a waiting game. Do they fill, Anne-Marie's Knicks cup up with oil because they run out of storage and they have to kind of give in? Or do you get to a position where, oil prices get so high and you start to worry about election and U.S. consumer risk and stuff like that?
So do you think the market is waking up to the more escalatory nature with the blockade or what OFAC did just yesterday going after more teapots in China than they are actually the physicality of what is going on?
Yeah, again, I think the equity markets are more than happy to ignore this until oil prices inflect. And the fact that we're not watching, bombs falling in the overnight gives us as equity investors even more freedom to do that. So, again, this is a time issue. And I think at some point, oil's not going to go, 105, 106, 108. It's probably going to go 105, 115 or something like that. And that's where I think it becomes a real issue for equity investors.
When do you think that happens?
I mean, if you believe our commodity strategists, you're 2 to 4 weeks out from that. But to be fair, to Lisa's point, 2 to 4 weeks ago, we might have said the same thing. So it could also be that in these times of stress, people find a little bit extra oil to squeeze out of things, right? Maybe you're running at 100% max production. Maybe you're running at 110% max production, i.e. a production level you can't sustain indefinitely, but you can sustain for a short period of time. So it could be we're squeezing a little more juice out of it than we thought we had.
You're not a bear. It's worth pointing that out. You're not a bear. You are actually looking at this quite bullishly at the moment. What underpins that bullish view?
The fundamentals. I think that's really what it boils down to. Any of these risks, whether it's the economic data or the Iran stuff, if you had earnings turning over in the U.S. would be red, and there'd be a much different reaction function. So I think that's the key. To me is one, this has been a little bit slower moving, and two, you have very strong sort of earnings fundamentals underpinning things, which is why I think if there's one thing that worries me is actually the NFIB and the UMISH surveys last month that just showed sentiment under so much pressure, because the longer this lasts, even though oil hasn't re-inflected, gasoline's at a 4-year high. So the refined products that really impact consumer spending are kind of, giving you that stress.
I really struggle with you, Mitch. So just convert me if you can. The idea that things have never been worse since the late 70s, that consumers have never felt worse, I just struggle with that.
Agreed.
I understand that things are bad now and it's difficult for a lot of households, without a doubt, and I'm not undermining that. Just to say that things are worse now than GFC, than all the other things we've been through in the last 40 to 50 years, I struggle with that. Do you?
Yeah, I struggle with it as well, though. I think the GFC was maybe a little too complicated, for some people, whereas price of gas is like an immediate hit in the face. Also, if you look at UMISH split by political party, you kind of see there's also a huge political aspect in there as well. So do I think we're the worst ever? No, but when I see both small businesses and those sentiment surveys both turning lower, again, this is a warning sign as opposed to something that is an issue now. But, if you keep sentiment under pressure for 3 or 4 more months, I think then you start to worry about what's going on. And it's also what gets you there. To get sentiment that negative, you probably need oil and gasoline prices high for an extended period of time. And I guarantee you the Fed is not going to be happy about that, if that's the outcome.
So geopolitical concerns, earnings, it brings us to the Fed. Do you care at all about what happens later this afternoon?
Hopefully not, and I don't think. Well, I don't think the Fed wants us to, right? Honestly, I think.
You never want us to.
Tune in 1:30 Eastern time. Thank you, Stuart. Go on.
Well, you can see if I'm wrong at 1:30, but I would say that they're going to probably keep with the forecast uncertainty very high line. The Warsh nomination is sort of back on track. And I think the Fed, gun to their head, would probably just say, we want to get through this without too much commotion. The press conference will be interesting. I thought the press conference was a little more loosey-goosey last time, maybe than it has been in the past. So we'll definitely be turning out to that and watching every minute of it. But I imagine the statement, et cetera, they'll try to keep that right down the middle.
So far, the chairman's future is a non-event for financial markets. Seems to be the event for Fed watchers. Is that something we need to reconcile? Do you think it becomes a market event?
It's hard for me to see it becoming a market event. If you assume that the DOJ charges kind of go away then, whether he stays on for another year or two, I'm not sure that's like a major issue unless it creates some sort of rift within the Fed, which seems unlikely. Warsh is a respected economist. He's worked at the Fed before. He respects the institution. So I wouldn't expect that to be the issue. I mean, if pillow fights are breaking out at the Fed between Powell and Warsh, maybe a different story. But generally speaking, no, I wouldn't expect it to be a huge issue.
Stuart, it's good to see you.
Good to see you too.
This was fun. Thank you, buddy. Thank you very much. Stuart Kaiser of Citi. On the Federal Reserve later on this afternoon, that news conference could be spicy on the future of Fed share and also, I think, most importantly, where we are in this economy and the outlook for policy and the changes we could expect in the next 12 months.
Yeah, right now, that is a huge uncertainty. You're talking about the University of Michigan survey and how negative it seemed. And then yesterday, we got the Conference Board consumer confidence number that came out way above expectations. So pick your poison and try to interpret what this economic data really looks like.
It's a difficult moment. Looking forward to the news conference, 2:30 Eastern Time. Our coverage starts at 1:30. Don't listen to Stu. Tune in for that.
It's going to be
amazing. At 2 p.m, we get that interest rate decision. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. The White House is working on dialing down its feud with AI giant Anthropic. Axios reporting the US is developing new guidance that would allow agencies to get around Anthropic's supply chain risk status and begin onboarding its new model, Mythos. Starbucks shares are up almost 5% in the pre-market. The company lifting its full-year guidance thanks to a strong rebound in the US that helped offset slower growth in China. The results suggest CEO Brian Nichols' turnaround plan is gaining traction. Billionaire Bill Ackman's Pershing Square pricing a combined IPO of Pershing Square USA and its hedge fund management company, Pershing Square Inc., in a dual listing expected to raise $5 billion. The two securities will begin trading on the NYSE today. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next, the morning calls, plus Shweta Khajuria of Wolfe Research saying Wall Street is underestimating CapEx spend heading into earnings. We'll get to that conversation in just a moment. Live from New York City this morning. Good morning.
When you just kind of look at, what these companies are at least going to do in Q1, I don't see any sort of major tick up in terms of CapEx budgets. That could change as we go into the second half of this year. A company like Meta, well outpacing the industry largely because of that AI contribution and what they're delivering from an AI perspective to, the ad community.
A huge afternoon for tech earnings coming up later on this afternoon. That and pillow fights at the Federal Reserve, according to Stuart Kaiser over at Citi.
Why pillow?
I don't know.
I mean, it's spitballs, maybe.
It's not that violent, which I like. I like that sentiment.
Yeah, please.
It looks like this. Futures just about unchanged on the S&P 500, positive on the Nasdaq by 0.2%, on the Russell up by 0.2. Let's get you some morning calls. First up, JPMorgan lowering its price target on Booking Holdings following earnings, citing the impact of the Middle East conflict on travel demand. That name is down some 4%. Your second call from Citi raising its price target on UPS after its first quarter results, seeing the sell-off in shares yesterday as an overreaction. That name is up by only 0.25%. And finally, BNP Paribas initiating coverage of Alibaba with an outperform rating, expecting cloud revenue growth to accelerate. That name is up by a little more than 1%. Elsewhere, four of the biggest companies on the planet reporting earnings after the closing bell this afternoon. With a preview, Ed Ludlow has more. Good morning, Ed.
Good morning, John. We're bracing for Earnmageddon, and capital expenditures is still the swing factor for the market, but probably given the Wall Street Journal reporting on OpenAI missing financial metrics in the market of the last 2 days, more than ever, Wall Street is looking for evidence of ROI. They want to see that capital expenditures is followed by boosted forward guidance and tangible revenue growth. And that's the dynamic of this market. It is an AI story, but if you think about how markets have behaved since the March bottom, take the S&P 500 or the NASDAQ 100, if you strip out NVIDIA, it is those four names that have been the big drivers of the multi-consecutive records that we've seen in recent weeks. So that's the story. Each of them has a comparable metric in CapEx. Meta does not have the cloud growth for us to track, but that is where we will look after 4 p.m. Eastern time today.
Armageddon. Getting Bramo excited, Ed. Armageddon this afternoon, Bramo.
Sorry, I couldn't hear anything. Earnmageddon.
Earnmageddon.
Earnmageddon. Earnmageddon.
Oh, no.
I wonder how long it took for you, Ed, to come up with.
Really, Ed.
Please have brought that up. Didn't know what I was looking for this afternoon. Ed, thank you, buddy.
That
Appreciate
conversation
it.
goes later in the show.
Looking forward to the coverage. That's later, yes. That's quite the promo for the IAEA later on this afternoon.
Hope that's
this
not
morning.
Armageddon. Let's hope we just get Earnmageddon.
Okay, yeah, I didn't hear that at all. All right.
Yeah, I thought that was...
Okay. Shweta Khajuria, Wolfe Research, writing the following. We expect 2027 capex for mega caps to increase 25 to 30% year over year. Shweta joins us now for more. Shweta, welcome to the programme. We had a conversation earlier on this morning about maybe entering a new phase for capex. Are you expecting an increase from here later on this afternoon?
Well, first of all, thanks for having me. As far as this year goes, I'm not sure if we'll expect a material raise in capex for 2026. In part, it's because the guidance that each of these companies gave, $200 billion for Amazon and $175 to $185 billion for Alphabet, for example, we think accounted for a good level of conservatism. But there is a risk, if there is one, it skews to the upside in terms of raising capex. Our point really was, as these contracts are up for renewal and we think about 2027, we have seen 100% increase in year-over-year pricing for storage as well as memory, and that's going to flow through. And that is what we think the street is underestimating when we think about next year's capex.
Is this a good increase or a bad increase in capex if it's tied to higher costs? I mean, how is it going to be received by markets?
Well, capex increase has been negatively viewed by the market, in part because now, despite the very attractive free cash flow generating profile for each of these mega caps, at least within the internet space, it is in question. And the question is whether Meta and Amazon and Google will need to raise more debt capital in order to support this level of demand by investing in capex. So I think that it's going to be viewed negatively unless we see some material inflection in their top line growth. And that is something that we may see at AWS as well as Google Cloud.
Is this something where we're going to get a sense of the winners and the losers at this point? You talk about AWS and Google in the cloud space, but also when it comes to the AI space, given the report yesterday from about OpenAI in the Wall Street Journal, suggesting that Gemini is really taking a lot of share.
Well, part of the reason why when a lot of the AI names yesterday pulled back, we did not see a major pullback in Alphabet shares. And part of that is because Google is fully vertically integrated with their own chips, with their own cloud service, as well as with their own Gemini model. And that is a huge advantage that Alphabet has. And so if the consumer-driven app in the form of GPT is not meeting its metrics, then the structural headwind on Google search is also mitigated. And at the same time, the hyperscaler cloud business is also up for a good level of acceleration with margin expansion. So we do think that will be a positive for Google.
So, Shweta, who do you think is winning that race right now? Is it Google, Gemini, as opposed to OpenAI and Anthropic?
Well, actually, Anthropic, we do think that they are ahead. When we think of their most recent models, we think that they are doing arguably better than most other industry-leading models, especially in security and coding for enterprises. So Anthropic is really firing on all cylinders. And when we think about their annualized revenue run rate, they're now, 30 billion plus, and who knows, by the end of the year, it'll be significantly higher on a run rate basis. So we do think that Google and Anthropic are doing fairly well. And at the same time, Amazon is also narrowing that gap, especially in their Trainium chips against TPUs and GPUs, and they're catching up fairly quickly. And we'll see, hopefully, 30% plus growth rate in AWS in the first quarter reported later this afternoon.
John has brought this up a lot when it comes to the likes of Anthropic and OpenAI. Is some of this just trying to generate buzz ahead of blockbuster IPOs? Or do you think these models are real and going to really change our realities in the future?
The latter. I think that there is a lot of potential in these models. And what we may see is that so far there's a little bit of a lag from a lot of enterprises that are talking about the promise of being able to cut costs within their organizations, but we haven't seen much of that yet, despite the adoption of coding, et cetera. So headcount growth will not only moderate, but we may see a lot more of headcount cuts that could be coming that could drive down to the profitability. So is that a good thing at a macro level where unemployment rate could rise? I'm not sure where the balance will shake out eventually. But on a profitability perspective, for a lot of enterprises, we may see a pretty good boost in terms of productivity and profits.
We've got a massive afternoon coming up. Thanks for making time for us this morning. Thank you, Shweta. We appreciate it. Thank you. Shweta Khajuria there of Wolfe Research. Let's talk about the OpenAI piece in the Wall Street Journal. This is really central. I think it's the epicenter, the foundations of the ultimate bear case, the bubble view, that you have a company that will fall short of growth, that has made massive spending commitments which will lead to a huge misallocation of resources and overcapacity. That was the pushback we got from the likes of CoreWeave in their own statement yesterday, which is we continue to see demand exceed supply across the AI ecosystem. That's the pushback you're going to hear repeatedly.
And they have other customers as well, that OpenAI is not their sole customer. This is the key point, that even if, say, OpenAI is overinvested and might have too many commitments, how many other players are there out there willing to take up those assets at the same prices? And that, I think, is reason why a lot of people are saying, even if OpenAI hits a soft patch, it isn't going to cause some sort of implosion in this particular industry.
Right, because there's so many other good models out there when it comes to Google Gemini, everyone that talks about Mythos and Anthropic. Interesting point, though, Jonathan, you brought up yesterday, not just the fact that OpenAI can't reach their internal targets, but when it comes to this IPO, the fact that maybe it's actually not as good, they can't reach their IPO, do they just get swallowed up potentially by someone else?
I've got no idea what happens here, and the growth numbers can change just as quickly, and I've mentioned this example of Alphabet repeatedly throughout this morning. You come out with a new model, things can change very, very fast, but let's just sort of run with where we are right now with this company. If they fall short, is the risk less existential for the Alphabets, for the Microsofts of this world? When they say right now, the greater risk is underinvesting and not overinvesting, is a lot of that because of what they see as an upcoming threat coming from elsewhere, from OpenAI, from Anthropic, and how would their view of those risks on the horizon change if that company went away?
Is there an existential threat because of the competition from some particular players who are hoovering up everything that they can find to try to make sure that they have the biggest footprint possible? Or is this an existential threat because this is going to be the business model ahead? And if they don't reach some sort of, intelligence that is beyond, then they're going to fall behind, right? Is it sort of an existential, we don't know what we're going toward, but we're going to try to keep building this tower to the sky? Or is this something that has a tangible kind of endpoint with a practical business application that they can see with respect to their customer demand?
These earnings calls could be very, very interesting later on this afternoon. Coming up next, we'll talk about the data, a fresh round of economic data set to cross. We'll speak to Tom Porcelli of Wells Fargo. He's with us to break it down and look ahead to a Federal Reserve interest rate decision later on this afternoon. That decision at 2 p.m, the news conference at 2:30. Into it, the price action looks like this. Equity futures just about unchanged on the S&P 500. The Nasdaq bouncing back by 0.3%, getting our attention once again. This move in crude, up by 3% on Brent, just short of 115, an 8-day winning streak for Brent crude, the longest since May of 2022. And with that push higher in the oil market, this in fixed income. Yields up again, 2 basis points higher at the front end of the curve, 386 from New York City. You're watching Bloomberg TV. "60 minutes out from the opening bell, the cash open just around the corner. Economic data dropping in about 20 seconds time. Equity futures into that. Just about unchanged on the S&P 500. Positive on the Nasdaq by 0.2. In the bond market, tracking the long end of the curve, very close to the highs of the year, with 30s at about 495. And the front end of the curve with yields pushing higher over the past few sessions, up another 2 basis points this morning. Let's round it up, 386. With that economic data, Mike McKee has more. Good morning, Mike.
Good morning, John. It's not quite eco-mageddon, but it is a lot of numbers this morning. Durable goods orders up 0.8%. That's a strong number. Transportation up 0.9. So that tells me off the top, without looking at the details, this is not just a Boeing story this time. Capital goods orders, non-defense ex-air, were up 3.3% after a 0.7 rise the month before. So a lot of strength in durables today. A suggestion that maybe AI is really strong. We'll take a look at what the breakdown of the numbers are. The advanced goods trade balance is wider than expected, comes in at $87.9 billion for the month of March, with imports up 3.3% after 5.1% in February. That suggests still strength in the economy pulling goods in. Exports were up 2.5%. That's down from the 5.9% we saw in February. And then finally, we've got housing starts. They are down they are up on the month by 10.8%. Could that be weather, or could it be just more confidence from builders out there? 1,502,000 pace for the year. It is building permits that were down 10.8%. So all in all, a fairly strong report suggesting some strength in the economy, which may have some implications for the Fed going forward.
Mike, looking forward to the Federal Reserve later this afternoon. You, of course, will be in the room in that news conference. Do you think it's problematic that we're spending more time talking about the chairman's future than we are about the economy and the future for policy?
Not really. And I've said that I wouldn't be surprised, put it this way, if the first question to Jay Powell wasn't, what's your future plans? Because we know the Fed isn't going to do anything now. They are sidelined, as are pretty much central banks around the world, waiting to see what happens with oil prices, with the war. And don't forget, we've got tariffs coming down the road. So there's a lot of uncertainty about where the economy is going. And strength in the U.S. economy just strengthens the Fed's hand, their ability to sit on the sidelines. We are going to watch today to see if they say there is a two-sided risk. They've been worried about unemployment as the major risk. Are they going to elevate inflation to that level today when they put out their statement? And, of course, we've got the Warsh confirmation vote today. After he's basically confirmed by the committee, then he has to go to the floor, but he will be confirmed there. Do people care what Jay Powell thinks about where the economy is going from here, or does the focus immediately shift to Warsh? That may be answered by what Powell says about how long he's going to stay on the committee.
That is very true. Mike, thank you. Looking forward to your coverage later on this afternoon. Mike McKee, of course, will break down that decision, and he'll be in that news conference at 2:30 Eastern Time. With us around the table, Tom Porcelli of Wells Fargo. Tom, good morning.
Hi. Do
you agree with the take from Mike McKee that it is not that problematic, that we're talking more about the chairman's future than we are about policy and the economy?
I love that you set it up that way. So, look, here we are with this massive tension, right, in the dual mandate. And I would bet that the very first question that he gets asked today at the presser is about whether he's staying or going. And I think when you have this kind of tension and you're asking that question first, yeah, I do. I think it's a distraction. And so what I would say is, I think it's actually incumbent on Powell to sort of highlight, well, if he is going to stay, why? Something more clear, because I thought we resolved part of this already, right? I thought part of the reason was the indictment. Well, if that's now off the table, then why would you stay? Because I think the risk is that he doesn't give us enough information, and then it becomes a question of, oh, what does he know that we don't? And then it becomes even more of a distraction. So I think he really has to thread a needle here on this.
Do you think it introduces a dependency issue for markets? Because right now I don't see one in the way markets are priced.
So I think, look, I think what markets want is just to get on with this. I think they want to know what the sort of, what the next meeting looks like. Is Warsh there, and is it also with Powell as a big shadow cast over him? I think what markets actually want is clarity.
Not to be a little bit flip, but do you think we're focusing on this? Because right now there's not that much more to say about the Fed.
So I would actually say I like being flipped too. But what I would argue that there is so much to talk about. Because when you think about the inflation dynamic that's in play right now, and the degree to which the Fed is going to focus on that. When you think about the labor backdrop, right? Like I wrote this in our daily yesterday. I would be stunned if someone asks him about the labor backdrop, when I think that there's a lot of tension in the labor backdrop, too. So, no, I actually think that there's a lot to focus on, and I think that this is acting as a big distraction.
The reason why I say that is because the Fed doesn't have control over most of what is causing some of these economic disruptions. We're talking about oil prices rising in the Middle East. That's clearly out of their control. We're talking about an employment market that might be as affected by artificial intelligence as anything else. Again, what's the Fed going to do about that? So how much does it really matter where the Fed sits? Aren't they just sort of sitting there being a receiver of all of the incoming information rather than a setter in any capacity?
It's such an important idea. And what I would say is, the Fed in a lot of ways will set the tone on this. I mean, I don't think that they could just be a passive, sort of listener of what's happening. I think they actually have to be an active engager of, hey, this is how we're thinking about how we might want to react to this. And by the way, if the reaction is, hey, we're just going to sit on the sidelines and wait and see how this unfolds, that's fine. But I think that messaging actually needs to be clear.
So then do they come out a little bit hawkish?
No, I think that they're supposed to be they are supposed to be as balanced as possible. Because I do think, so from our perspective, when you think about this inflation dynamic, I think Lisa's spot on. This is a supply shock. There's literally nothing the Fed can do about that. But I think on the labor side of the mandate, I think that there's actually a lot that they actually, I think, should be a little bit more worried about. I mean, the underbelly of labor, I think, is softer than most people appreciate. And that, for us, if you can find this exit ramp, which I think the administration wants to do sort of sooner than later, if you can find that exit ramp, I think that actually would clear the way for the Fed to be able to ease policy later in the year. But so much has to go right between now and then, and I think that's the conversation that the Fed is supposed to be having.
So you think the Fed still has a cut potentially this year when Kevin Warsh comes in?
Yes.
And he's going to use the labor market as his
By the way, I mean, again, to Lisa's observation on AI, we just wrote a note on this just this week, actually. We think that AI is having a marginal impact at best at this point on the labor backdrop. So when I hear the argument of, hey, by the way, we're going to be able to cut because AI is going to usher in disinflation, I don't disagree with that as an idea. I disagree with the timing. It's not going to happen anytime soon. So your best argument for cutting this year is the labor backdrop.
It's funny you say that. It was hardly mentioned in the hearing with Kevin Warsh. The focus was almost solely on the other side of the mandate. Why do you think that is?
Because I think at the end of the day, when you think about inflation, it is a significant issue for Main Street, right? That is just the reality. When you think about the people that are sort of asking the questions, they're going to want to make sure that the Main Street folks are covered in that regard, and I think that's why that actually came up more than even the labor side. In fact, I would say it was far more than the labor side. Although as I've been arguing, I think we need to focus on labor.
Mike McKee, tracking the data. Mike, I know you've got more. What do you see?
Well, I broke down the durable goods orders, and it is really interesting. There is a huge jump in equipment that one would assume is made for AI and AI data centers. Computers and electronic products were up 3.7%, the orders numbers, after 1.3% the month before. Communications equipment up 3%. So we are seeing some strength in that area, and this comes as non-defense aircraft orders were down by 21%. So it isn't a Boeing story. We did see an increase of 16.9% in defense aircraft orders, which would also include things like missiles, et cetera. So the war having an impact there. But Boeing didn't carry this one. It is the AI economy that seems to be moving the needle here.
Mike McKee, thank you. We've seen that repeatedly, Bramo, repeatedly.
Yeah, this is the tension that I have. How do you deal with the fact that people say that the labor market could get hit by AI? This is all hypothetical. We don't know if it's going to be disinflationary.
Sure.
We don't know how much it's going to cause unemployment to surge. At the same time that the capital markets are wide open to finance all of these purchases for all of this AI equipment, even at higher prices, because people view it as existential. So that's where the inflationary aspect goes in, with really mixed signals from the employment market. I mean, it's a conundrum wrapped in an
I know
enigma.
where you're going. Don't worry.
Yeah, whatever. Carry on.
Tom, we should build on this. Can you walk me through how your conversations with clients are going at the moment? Because I'm just thinking about the future and whether non-farm payrolls, which was like tier one economic data for financial markets and setting the tone for risk assets, whether it becomes less relevant.
Yeah, I think right now it is less relevant. I mean, if I would order the things that we're talking about with clients, it's basically the Iran conflict, how that's going to impact the backdrop, inflation, obviously on the back of that. AI is coming up in virtually every meeting. Even, by the way, in the very early stages of the Iran conflict, people still found time to ask about AI. I mean, it was coming up relentlessly, which is why when I hear Mike McKee say, hey, CapEx crushed it, yeah, that makes a lot of sense. I mean, I think, Q2 and Q3, we actually have CapEx performing incredibly well. So I think in terms of focus, it makes a lot of sense what clients are focused on, right? It's how is Iran going to impact the inflationary backdrop, and what is the Fed's reaction function to that? And our answer is the same, and it's been the same for the last month and a half. The Fed is going to sit on the sidelines because there's nothing they can do about a supply shock.
We're told repeatedly that the labour market simply isn't strong enough to generate broad-based price pressure in this economy. Do you agree with that?
I 100% agree with that. I think, when we heard this conversation about the Fed, hiking rates, that was for us, that was an immediate fade. To be able to actually hike rates, you would need a demand shock to come into play, right? You would need some kind of wage price spiral dynamic. And how would you get there? The way that you would get there is if there's some additional new fiscal stimulus, not the stuff that's already in tow in the back of tax refunds. You need something new, I think, to really sort of put not just a floor underneath inflation, but to elevate inflation.
So if they introduced a more symmetrical reaction function later on, at least communicated one or attempted to, would you dismiss that, look through it?
I actually have a lot of sympathy for that, because I do think at the end of the day that they still need to defend their credibility as it relates to inflation. And so in that context, I have sympathy for it.
Tom, it's good to see you.
Good to see
Appreciate
you.
it.
Thanks.
Thank you, sir. Tom Porcelli there of Wells Fargo on the Federal Reserve, that interest rate decision later on this afternoon, with an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. So recapping the data we just got, the U.S. trade deficit coming in line with estimates at $87.9 billion in March. U.S. orders for business equipment increasing by the most since 2020. The big surprise was in housing starts. They were up nearly 11% compared to estimates that called for a drop of 0.4%. United Airlines and Lyft are teaming up. Starting today, United Mileage Plus members can use their miles to pay for rides. This is the first time an airline loyalty program and rideshare platform have offered direct mile-to-ride redemption in the United States. In sports, the San Antonio Spurs are moving on to the second round of the playoffs after beating the Portland Trail Blazers in 5 games. Philadelphia defeated Boston to force a Game 6 at home, and the New York Knicks are 1 win away from the next round after beating Atlanta by nearly 30 points in Game 5. And that is your Bloomberg Brief. John.
You happy with that?
126 to 97.
Okay.
Incredible game.
Was this a Celsius morning? Is that what that was this morning?
No, I had, what did someone say? I have crude oil in my coffee. That's where we're at right now.
Up late at the game last night, just about holding it together. All right, up next on the programme, the IAEA Director General Rafael Grossi as US-Iran talks stall over Tehran's nuclear programme. Plus, we'll catch up with Yahira. She's got your morning movers. Bloom Energy soaring after eyeing a massive growth pathway. That name is up by 18% in the pre-market.
I would love to see everybody say things that are in line with what everyone is expecting. I'd love to see everything come in a way that calms everybody down post the AI stories. Everyone is looking to make sure that this growth is still as strong as it has been. And the bigger you get and the larger the numbers get, the harder that becomes.
That was Sarah Hunt of Alpine Saxon words on the programme a little bit earlier this morning. Going into the opening bell, 44 minutes away. Your price action shaping up as follows. Equity futures on the S&P just about unchanged. Bouncing back on the Nasdaq higher by 0.25%. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Ahead of tech earnings, this is the power story. Shares of Bloom Energy soaring nearly 19% in the pre-market as demand for power tied to AI data centers ramps up fast, helping the company deliver a beat and a raise. Analysts taking notice, raising their price targets. Moving on to Etsy, the online marketplace. Shares are up more than 7% in the pre-market after it gave a better forecast than expected, and that's because customers are spending more per transaction. And we end on shares of SoFi Technologies. They're plunging 8.5% in the pre-market, and this is really a cost story because other than that, the company delivered strong growth across the board on both revenue and membership, but expenses jumped more than expected. John?
Yahira, thank you. Thanks for the update. Great word this morning. Let's count you down to just an amazing 24 hours. Look at the diary, the calendar, shaping up as follows. Later this morning at 10 a.m., a Senate Banking Committee vote on Kevin Walsh. Later on this afternoon at 2 p.m., we get a Federal Reserve interest rate decision. 30 minutes later, a news conference, then earnings from Microsoft, Amazon, Meta, Alphabet, and then tomorrow we hear from Apple.
This is really the blockbuster week, and today is the blockbuster day, so stay tuned. We'll be here all day.
Looking forward to it, right?
I
1:30.
think I am.
Coverage
This is going
starts
to be
at
a really
1:30.
interesting one.
Armageddon.
You sticking around for that? 1:30.
We're not calling it that.
Yeah.
Bloomberg Surveillance, the Fed decides. No.
I'm going to tune in from home.
Someone didn't sleep last night.
Yeah.
All right. Let's turn to the war in Iran. President Donald Trump reportedly gearing up for a prolonged blockade of Iranian ports. Peace talks on hold, with the future of Tehran's nuclear program remaining the key sticking point. The IAEA Director General, Rafael Grossi, warning that any new deal that doesn't guarantee the agency's monitoring on the ground will, quote, have an illusion of an agreement. Director Grossi joins us now for more. Director, good morning. Good to see you.
Hello, good morning.
Welcome to New York, and thanks for spending some time with us this morning. I've got a simple question, one I think a lot of people are thinking about. Do we know where the uranium actually is at the moment?
We knew, and we think we know. Most of this stockpile was, for the most part, in a big nuclear compound, which is called Isfahan, near the city of Isfahan. It was there. It was stocked there at the time of the 12-day war last year. So it is believed that the consensus of the community is that it is still there. Even the Iranians have said that it is. So yeah, that's the situation.
Is there any enriched uranium above ground that the Iranians could access, and if so, at what enrichment level?
Well, there could be some amounts on another site, which is called Natanz. But I think both, even the underground and the above ground, which is a smaller quantity, would be accessible in case there was a wish to be there, to go there.
So what do you think the appropriate solution should be? Is there an off-ramp where maybe some of this could be moved to a third-party country?
Well, there is a negotiation. So it is for those negotiating to determine what they want or what they can achieve together in this process. It is, of course, clear that the issue of this material must be addressed some way or another. And there are different alternatives that have been considered, shipping it out, downblending it. And so it is for them to decide. The fact that there is this material is a fact. It is for them to decide. What the IAEA needs to know is that this material is not being diverted. It is accounted for, and we can check where this is.
Does the IAEA have an idea of what survived in terms of centrifuges? How many when it comes to the U.S.-Israeli attack?
Not exactly, because we haven't been able to return there. However, we know these places very, very well. We know the different characteristics of the buildings, and we know the kind of kinetic force that was used there. We do have satellite imagery, so we have a pretty good idea of what might still be there.
We have a ceasefire. Is it part of the negotiations, the talks? Have you asked to get access to these sites, to get your inspectors back in?
Well, I will put it, more or less. I will put it slightly differently. It is, the idea is that when there is an agreement, one essential component of that agreement is that whatever is agreed is inspectable, verifiable. In introduction, you were quoting something I said, that an agreement without verification is an illusion of an agreement. It's a promise. Who knows?
So I know you've been in touch with Steve Witkoff, Jared Kushner.
Yes.
Have you seen or spoken to President Trump as well as the Iranian side?
I've been working with Special Envoy Ambassador Witkoff and with Dr. Kushner, yes.
Are you closer to getting them back at the table?
To getting whom to the table?
The Iranians and the Americans back at the table?
To a certain extent, there is a table, and they have this table, it's on and off, but there is a conversation, yeah.
Have you returned to Iran since February 28th?
Myself? Or, the inspectors,
IAEA.
the IAEA, yes, partially, because we have been able to return to the places that were not attacked. Right? So the Iranians are making our return contingent to an agreement.
How much are you concerned that this episode will only reignite nuclear aspirations around the world in countries that see the success of North Korea and, frankly, the success of Iran, at least in the threat potentially to fend off this type of attack again, should they actually acquire a nuclear weapon?
I've heard that, and that is an argument that I frankly disagree with, and I'll tell you why. We've seen all the commotion and even war, destruction and misery proliferation attempts bring. You see this, and I'm not saying whether it was justified or not. I'm just telling you, see this, and let's go back in history. Let's go to Iraq. Let's go to Syria. Let's go to Libya. Every time there has been one of these attempts to get to nuclear weapon or weapons of mass destruction, for that matter, there has been a problem. There have been wars. There has been death and destruction.
At the same time, in Bloomberg today, there was a big story about how North Korea is actually accelerating its production of nuclear weapons and potentially is on track to have one of the biggest stockpiles out there and potentially could overwhelm any kind of countermeasures in the region. I mean, at what point do you expect to see more of this, considering that there are nations that would like to immunize themselves from these types of threats?
We cannot exclude it. I mean, you have a point. We cannot exclude it. The case of the DPRK, I mean, they proliferated in 2006. So 20 years ago, almost 20 years ago, they decided to cross the line, they tested, they expelled the IAEA inspectors a little bit later, I must say, because it's a story that has lots of ups and downs and processes, not dissimilar in a certain sense with what is being attempted with Iran, incentives, of sorts, and then at some point that country, in a different geopolitical, geographical scenario, decided to cross the line.
North Korea, precisely the situation we're hoping to avoid in Iran.
Well, exactly. And right now, they seem to be amping up the stakes, considering that there's a report about how much more they have in terms of their nuclear stockpiles.
Director Grossi, appreciate your time. And we know you're in the running to become the next UN Secretary General, so best of luck with that effort.
Thank you very much.
Thank you, sir. Appreciate it. The IAEA Director General, Rafael Grossi, there on the situation in Iran. The situation for financial markets right now, looking ahead to this a little bit later on this afternoon. What an afternoon we've got coming up for you at 2 p.m. Eastern Time. Tune in later on this afternoon for Surveillance, the Fed Decides. Kicks off at about 1:30. The decision at 2 p.m. We'll catch up with Bob Michael of JPMorgan, Sabahat Rajapra of SocGen, Matt Lazzetti of Deutsche Bank, Jeff Rosenberg of BlackRock. Then we've got to look forward to tons of earnings after the closing bell.
Which ultimately may render anything that we hear in the Fed meeting not interesting. I'm sure Jay Powell really hopes so.
Well, the Fed meeting will be interesting as long as Jay Powell gives us a little bit more of a hint of what his future holds.
Pillow fight at the Federal Reserve.
Yeah.
Hey, Stuart Kaiser at Citi.
I don't want that image.
No,
not
interested in them running around in PJs
maybe.
at the Federal Reserve.
No slumber party. Rejected.
Fancy
I'd rather have Earn-mageddon.
Hard pass. What was that about?
No, I can't.
He worked hard on
All
that.
Right. Long day ahead on Wall Street. We'll see you later from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.